What if you could make the most of your financial situation so that you can pay your home loan off faster? What if you could save thousands, if not hundreds of thousands of dollars on your home loan? What if you could also set yourself up in life so that you can really start to build wealth? This is Pay It in 5. I'm Dr. Linda Hamilton. We paid our home loan off in 5 years. I wrote Pay It in 5 to share how you can pay your home loan off faster and make money work for you. Pay It in 5. How to pay your home loan off in 5 to 10 years. Written and read aloud by Linda Hamilton. Introduction. How I came to write this book. During the decade before we acquired our first home loan, we enjoyed a less financially committed life, renting in apartments, going out and travelling. We were renting a 1-bedroom apartment when we welcomed into our life our first beautiful baby. Living in a 1-bedroom apartment with a baby, we became very eager, very quickly, to find more room and decided to commit to and purchase our first home. In June 2011, we began making repayments on our first home loan. Whilst our home loan repayments began in 2011, our home loan journey commenced well before this time, when I started to research home loans. We didn't want to pay hundreds of thousands of dollars in interest. We wanted to pay off our property as fast as possible and instead save hundreds of thousands of dollars. After sharing what we were doing with friends, I realised that this kind of thinking and number crunching didn't come naturally for everyone. A lot of people don't even think that it's possible. But if you have a regular income and can get a home loan, then you can pay your home loan off faster too. And when you pay your home loan off faster, you can set yourself up in life. And why not? Nobody else is going to do it for you. You don't have to be a math guru to be able to save hundreds of thousands of dollars on your home loan. You just need the right tools and a little know-how. This book gives you access to both. The secret. Now, we were not high income earners, but we did it. We had one average full-time wage, one off and on casual wage, and we had 2 young children. And how did we do it? We borrowed what we could repay in 5 years. And it's as easy as that. That's really our secret. Okay, so there was a bit of prep work that went into planning all of this, and I'll share this all with you. But that's basically what it boils down to. And if there's one thing to take away from this book, this is it. Purchase within your means, whatever your situation. We purchased a property that we knew we could repay within 5 years with the income that we had. We worked out how much we could repay every week, and we worked out how much we could borrow to be able to pay it off with what we could afford. And we stuck with that amount when purchasing. We bought within our means so that we could pay it off in 5 years. Don't worry, I know. House prices are expensive. You can still make great savings paying your home loan off in 7, 10 or 15 years. Doesn't have to be in 5 years. I'll go through each step in detail on how you can pay your home loan off faster too. I'll go through each step in detail on how you can pay your home loan off faster too. There will be a little bit of calculating involved, but don't worry, you don't have to be a math guru. It all starts with turning your home loan thinking upside down. I call this reverse home loan thinking, which I'll talk about soon. And I developed the reverse home loan calculator. It's free on payitin5.com to help you do just that. Don't worry, it's easy to use. I personally like the downloadable version, and I keep this handy on my computer so I can save what I've done. 5 easy steps. With Pay It in 5, it's all about 5. 5 years, 5 steps. I created 5 steps so that it's easy to do and remember. I started documenting what we did in this book because I knew that with these 5 steps, we could do it. I wanted to share this so that you too can save thousands, if not hundreds of thousands of dollars on your home loan. It took me over 10 years to write this book, and it contains everything we learned along the way, including everything we learned buying our second property. Now I'm passing that knowledge on to you. This book encompasses the 5 steps to paying your home loan off in 5 years. The information contained within this book can help you learn how to pay your home loan off faster, whether you are about to take out a home loan or you already have one. The 5 steps are: Step 1. Plan. It is easy to fall in love with a house and lose sight of the bigger picture when you are looking for a property. This step helps you to get some perspective and to think about your home loan in reverse. Step 2. Calculate. Thinking about calculating home loan costs can be overwhelming. The good news is you don't have to be a math guru to work it out. This chapter shows you how you can pay your home loan off faster. Step 3. Borrow. Buying a property doesn't happen every day. Step 3 equips you with the knowledge and questions so you're ready to borrow. Step 4. Buy. There are so many obstacles to buying a house. This step helps you to navigate the world of buying, learn from our mistakes and our successes. Step 5. Manage. After you buy a property, it can be easy to get caught up in the home loan and forget about your original plan. Step 5 helps you to stay on track so you can achieve your ultimate home loan goal. I didn't write this book for it to sit on a shelf, or worse, to be lost in someone's digital labyrinth. I wrote this book to share how we did it in 5 easy steps and how you can do it too. As a thank you for purchasing this book and for listening, I have a free gift for you. I have developed some tools and calculators that helped us to pay it in 5, and they're free for you to use. Simply head to payitin5.com, then head to our gifts page and enter the password 1234 to find tools that complement this book. Use this book in conjunction with those resources to work out the best plan for your situation. You can also head to our website if you'd like one-on-one coaching on how you can do it too. I get a feeling of satisfaction when I create something that saves me loads of time. I hope these resources save you loads of time too, and money. And the best thing is, all the principles in this book can be used at any time during your home loan journey. I continually return to this book to remind myself how we did it before and of the underlying principles. And yet, I wrote this book. Maybe you are a first home buyer. Maybe you already have a home loan. Maybe you want to buy a holiday house to retire in. Whatever your situation, the principles in this book can help you get there faster. This book shares how you can do the same. You will be able to create a plan to pay it off faster, create healthy money habits, and get rid of bad ones to prepare for meeting with lenders before you get a home loan You are going to love my list of 30 questions you can ask your lender. In store for you a little later, all tried and tested. And how to see your home loan plan through. I'm passing the secret on to you, so you can do it too. When we did finally purchase our first home, we not only stayed on track, but we were able then to buy a house in our favourite location. We would not have been able to do it if we didn't follow the principles in this book. And in the meantime, I kept plugging away at this book, little by little. Well, it did take me over 10 years, updating it with all of our lessons learned and any new information from both of our purchases, so I could share everything you need to be able to do the same. Now you might be wondering, why 5 years? While I wrote this book to show that it can be done in 5 years, it does not have to be done in 5 years. You can take longer. In some situations, it may not even be possible to pay your home loan off in 5 years. For example, if you already have a loan that is bigger than it's possible to pay in 5 years. Or maybe you want to buy a bigger house. Our second property was not one we paid off in 5 years. Our situation was different. For us, we wanted to live in our favourite location. In the end, we bought because the interest we would pay on buying the property was cheaper than rent. So it made sense to buy. Then I developed another plan to pay our home loan off faster, using the same principles, but this time with a slightly longer time frame than 5 years. You may wish to pay your home loan off in 7, 10 or 15 years. Either way, you save money, and lots of it. These 5 easy steps helped us to reach our home loan goals faster, and can help you reach yours faster too. Whatever your situation, whatever stage you are at in your home loan journey, you can get there faster. Use this book as a guide and take from it what is relevant for you and your situation. As you read along, think about the big takeaways for your situation. Highlight important areas for you in the book. Take notes and then come back and revisit the book. Don't be afraid to consult the book again and again and again. Even though I wrote this book, it is still too much for me to remember when I need it again. I still come back to this book as a reminder of what to do. I would love to hear about how this book helps you. Tag #PayItIn5 on social media to share your journey with me, and drop me a message via paidin5.com. Happy house hunting and best wishes on your home loan journey. Paid in 5. Linda Hamilton. Step 1. Plan. A goal without a plan is just a wish. Quote by Antoine de Saint-Exupéry. Chapter 1. Get some perspective. Why are you buying? And don't say it's because you want to. It may seem like a silly question to ask. Why are you buying? But it helps to put your purchase into perspective. Many property purchases, and those we missed out on, are invested with strong emotions. When we look at a property, it is easy to fall in love with a property. Don't deny it. You know what I mean. That property that you just have to have. I've done this so many times, and so many times I have been disappointed not to get the property. That feeling of being attached to a property, of imagining yourself living in the property, of renovating the property in your mind, and imagining what you would do with the property if it was yours. These feelings, this emotion, is strong when you're looking to buy. But if you stop to think about why you are really buying, that property may not seem so compelling anymore, and you may start to change tactics for what you are buying. You'll look in areas you might not have considered before. You might lower your expectations for the inclusions you have to have. And you'll take out some of the emotional part of buying because you're buying for a specific purpose rather than a property you fall in love with. Once you ask yourself why you are buying, sure, it may not make these feelings go away completely, but it can start to put home buying into perspective and take out some of the emotional part of buying. Consider this. If you are purchasing a first home, what would be important considerations for you? You'll know that it's not going to be a forever home, so you might be more willing to make concessions. For example, you may consider buying something further away from the city, further away from your ideal area, or to settle with something smaller, like an apartment, as opposed to buying a big home immediately. Or you may decide that because it is a first home purchase, that you can take advantage of government or developer incentives for first home buyers. On the other hand, what would you look for if you were buying an investment property? Does this look different to buying a first home? If you're buying an investment property, you might be willing to buy a property without all the high-end finishes. You may be more willing to look for something easier to maintain, and your priorities may be around access to public transport, schools, and shops. Alternatively, if you're looking for a holiday house, you might be happy with an apartment, so you don't have to mow the lawn. Or maybe you'll focus on something that can be rented out if need be. Or even a property that you can see yourself living in when you retire, such as a single-storey dwelling. On the other hand, if you are buying because the interest is cheaper than rent, then maybe you are looking for almost anything, and you don't necessarily have to pay it off in 5 years, but you would like to do it relatively quickly. What about buying a house to renovate and sell? You can see how thinking about why you want to buy changes the kind of property you might be looking for. The reason we bought our first home was because it was our first home. It was something we wanted to pay off quickly. It was a property we wanted to take advantage of with government incentives. As a first home buyer at the time, you didn't have to pay stamp duty on properties under $500,000, which meant we only considered properties under $500,000. We were willing to buy in an area outside our ideal area. The property we purchased was well outside of our ideal area, over an hour's drive. For us, it was a first home, not a forever home, so we purchased a home that would be easy to maintain. Single story, small yard, easy garden. It didn't make sense for us to buy a large home and get a big home loan when we only wanted to live in it for a short amount of time and pay it off quickly. In doing this, we saved ourselves hundreds of thousands of dollars in interest, and in the meantime, we saved a very healthy deposit for a home in our favourite location. When we purchased our second property, we had other reasons for buying. This time, we wanted to live in our favourite location. It wasn't possible for us to buy a property in that location and pay it off within 5 years because the area was just too expensive. But we purchased because it was cheaper to buy than to rent, and we set ourselves a new target for just over 10 years to pay it off. This time, we weren't set on buying a property we could pay off in 5 years. We applied the same principles to make the process much faster. Take a minute to think about why you want to buy and write that down somewhere. Here are 3 questions you can ask yourself to get started. Number 1, finish this sentence. I am buying because. Number 2, thinking about your reason for buying, describe what you are looking to buy. For example, smaller yard, single story. Number 3, which suburbs outside of your ideal area are you willing to consider? When you're looking to buy, it's easy to lose sight of the bigger picture of paying your home loan off faster and to get lost in the dream of the big house in your favourite suburb straight away. Our friends had bigger, more expensive houses, but it didn't matter. We knew we weren't going to live there forever, and we were comfortable in our home. You don't have to have the biggest and best house when it is your first home. It may not be your forever home. That big house in your favourite suburb might happen one day. Maybe you're working towards that, but it doesn't have to happen right away. When you are starting out, you need to set yourself up so that you can buy your dream home later. If you buy a bigger place now, it will just mean it will take you longer to buy your dream home later. Whenever you feel the urge to buy the bigger, better house, remind yourself of your why. This can help you feel grounded when those emotions run high on that property you have to have. Chapter 2. What's wrong with how we think about home loans? When we go to the bank or the mortgage broker, we sit down, we give them information about how much we earn, they do some calculating, and then they'll tell us, okay, so the maximum we can lend you is $400,000 or whatever amount that they tell you. And we think, great, the bank can lend us $400,000 and we have a $100,000 deposit. This means we can buy something for $500,000. Let's start looking for properties at that price. But this is the biggest first home buyer mistake that can be made. People let how much they can borrow determine how much they spend and how much they repay. For example, now that I can borrow $400,000, how much did the bank say are my repayments? But this is a trap. Actually, I should say, but wait. There are two big traps. Big trap number 1, overspending. Just because there is a maximum you can borrow, you don't have to borrow it. When we let how much we can borrow determine the price of house we want to buy, we let our lender decide how much we should borrow. But don't let the lender determine how much you can spend on a property. You don't have to borrow that much money. You don't have to borrow as much as they are willing to give you. And you don't have to buy the most expensive house you could possibly afford. If you are not careful, letting your lender decide how much you can borrow could lead you to take out a bigger loan than you would have liked, particularly a first home. The more you borrow, the more you spend, the higher your repayments. The longer it takes to pay off your home loan, the more interest you pay over the life of your loan, and the longer it takes you to buy the house of your dreams. Don't spend all your money in one go on a slightly better property now, when you could have a much better property later by saving more in the short term with a smaller loan. Keep the debt small and manageable. That way, you can pay it off faster and save yourself hundreds of thousands of dollars in interest repayments. If you let the lender determine your home loan and how much you ultimately spend, you could be paying hundreds of thousands of dollars more in interest than you want to. And then repaying your home loan will feel like it drags on. You need to decide for yourself how much you will borrow based on knowing how much that means you can repay over the life of your loan. More on this in step 2, calculate. How much you spend on a property should never be determined by how much you can borrow. You need to decide how much you want to borrow. We'll come back to this. Big trap number 2. Making minimum repayments. When a lender tells you how much you can borrow, they will also tell you how much to repay. That is, the amount you have to repay every week, fortnight or month to pay your home loan off. However, when they tell you the repayments, don't think of this as the repayment amount. Instead, think of this as the minimum repayment amount you have to make, no matter what. The amount you have to pay back in order not to fall behind or go into arrears with your lender. You don't ever want this to happen. And then set your own repayment amount. Don't worry, step 2 takes you through this. The only way to get ahead is by setting a repayment amount that is more than the minimum repayment amount set by your lender. Always pay more whenever possible. The higher your repayments, the more you save. The faster you pay off your home loan, the less interest you pay over the life of your home loan, and the faster you could either be debt-free or buying your next property. Always make higher repayments than the repayments set by your lender. Always. There is a way for you to do this that will allow you more flexibility when using that money later. When I say always make higher repayments, there is something you should know. You can split up the repayment and put them into 2 different accounts. You can put your normal minimum repayment into your home loan account and then put the rest, the additional amount you want to repay, into an offset account. If you're not sure why or what this is, don't worry, I'll come back to this point again later. Chapter 3. Start with the end in mind. How many times have you heard this saying? Start with the end in mind. But what does it actually mean? And how can it be applied to a home loan? Some people might say that it means to visualize yourself as having paid off your home loan. What would that look like? Would you take more holidays? Would you take more luxurious holidays? Would you start buying organic food? Would you buy a fancier car? Would you have extravagant parties? What would you do? And how would you feel? Ecstatic, free, happier? Or maybe less stressed because you no longer have a home loan over your head? Sure, I can create a wonderful, idealized, romanticized image in my mind, but that doesn't actually help me to pay my home loan off. I can even imagine the feeling of what it's like to be home loan free, but that's not practical either. Thinking about how I imagine my life to look like and feel like after I repay my home loan are not going to help me actually get there. I can dream as much as I like. I am very good at daydreaming, by the way. And I can have as much wishful thinking as I like. But that is not going to pay off my home loan. It's much simpler than that. It's much simpler than trying to come up with a visual representation of what life would be like when you're debt-free. When I think about starting with the end in mind, for me, this starts with asking one question. When? When do you want to pay your home loan off by? When do you want this home loan to end? In listening to this audiobook, you might be thinking, well, it's 5 years, of course. Otherwise, I wouldn't be listening to this. I wrote the book to show that it can be done in 5 years, but in some situations, it may not be possible. For example, maybe you already have a home loan that cannot be paid off in 5 years. Maybe house prices are too expensive to pay off in 5 years. Maybe your deposit is smaller than you would have liked for the house that you want. Maybe you want to buy a family home, and family homes are generally more expensive. We purchased our first home because we wanted to buy a first home that we could pay off in 5 years. We bought a cheap home in a suburb over an hour's drive from Sydney. When it came to buying our second home, a house in our favourite location, we were willing to buy something that would take us longer than 5 years to pay off. We used the same principles behind this book to create a plan that would allow us to pay it off in just over 10 years. It was still faster than 30 years, and we were still saving hundreds of thousands of dollars. Whatever your situation, whatever stage you are at in your home loan journey, you can get there faster. The principles of pay it in 5 are still relevant, no matter where you are in your home loan journey. This book is all about paying your home loan off faster. It doesn't have to be in 5 years. It can be done in 7, 10, or 15 years if you like. You choose how many years you would like to pay your home loan off based on your situation. If it takes 7 or more years, that's still great, and definitely beats 30 years. If you are a first home buyer, try to aim for somewhere between 5 and 10 years, because that is where you will see the most amount of saving. Anything less than 20 or 15 years is a win, but between 5 and 10 years is a great place to make big savings. Really big savings. And who doesn't want to save hundreds of thousands of dollars? You'll want to pay your home loan off faster because you will love being able to save lots of money in a short amount of time, so you can buy your home in your favourite location sooner, or spend it in any way you please, like holidays on the coral reef or the ski fields. Once you have paid off your home loan, you can do whatever you like with your money, as it will be your money again. We paid our home loan off faster, and you know what? You can too. Chapter 4. Consider home loans in reverse. In Chapter 2, I talked about how people generally let the information they receive from their lender determine how much they spend and how much they repay. Most people look at how much they can borrow before they even consider why they want to buy, how long they want to borrow for, or even the maximum amount of interest they want to repay. Yes, without considering the maximum amount of interest they want to pay as well. I'll come back to this topic later. It's worth talking about further. We look at it in reverse and start by asking, why am I buying? Followed by when. How many years do we want to pay our home loan off in? This is known as reverse home loan thinking. You start with your why. Why are you buying? You think about your when. When do you want to pay it off by? And next, you consider how. If your why is to buy a first home and your when is to pay it off in 5 to 10 years, how are you going to be able to do this? To get to the how, we must ask ourselves 2 more very important questions before considering how much we want to borrow, which I will get to very soon. The only way you can pay your home loan off in 5 to 10 years is for you to decide that you want to pay it off in that amount of time and then work towards making that happen. Do you want to pay it off in 5 to 10 years? Are you willing to take longer if necessary? If you're still not sure, go back to your reason for buying. If you are buying a first home, then you might opt to pay it off in 5 to 10 years. If you're buying a family home, maybe you're okay with buying something at a higher price so that you can get the right property and pay it off over a longer period of time, such as 12 or 15 years. The only way to actually pay a home loan off faster is to have a goal for how long you want to pay it off for and then make repayments in line with that. You'll find out how to work this out shortly. And don't worry, you can change your when later too if you need to. So right now, write down, how many years would you like to pay your home loan off in? This may change, but it's good to start somewhere. Chapter 5. Buy within your means. When I was completing my PhD, one of my supervisors would say to me, "How do you eat an elephant?" At which point all I would think was, I don't want to eat an elephant. And I would give her a bewildered look of, I have no idea what you are talking about. To which she would answer her own question by saying, one bite at a time. Obviously, she didn't mean this literally, but this was a message she constantly said during our meetings. On the one hand, she was right. To get through something, no matter how big it is, the only way to get through it is by taking one step at a time, or one bite at a time. But still, every time she said it, I would think, I still don't want to eat an elephant. I soon realised there was one fatal flaw to this analogy. The fatal flaw. The thing is, you don't have to eat an elephant. You could eat something smaller. Take my PhD, for example. When you complete a PhD, you have 3 years to complete it. One of our colleagues finished theirs in 2.5 years. That's very impressive. I completed mine in 4.5 years. But here's the thing. Even if I wanted to finish in 3 years, it would not have been possible to do so. I was collecting data at the end of my 3rd year, when I should have been finishing. And yes, as crazy as it was, this was planned. There was no way I could have finished in 3 years, even if I wanted to. So what has this got to do with paying off your home loan? The problem was, during my PhD, I was given an elephant, a massive project that I was expected to complete in 3 years, when it wasn't physically possible to do so, given that at the end of 3 years I was still collecting data. When you get a home loan, you don't have to get a big one. Get one that is manageable, one that is within your means to pay off within 5 years, or 7, or 8, or 10, etc. If it is your first home, buy a smaller property in an area outside of your ideal location so that you can pay it off faster, and then you have a chunk of money to do something else with. For example, you could buy a home in your ideal area later, which is what we did. You can take out a smaller home loan. How not to eat an elephant. The underlying principle of how do you eat an elephant, one bite at a time, is true. The only way to get through something so big is bit by bit, or step by step. This is because everything is cumulative. The more often you pay your home loan and the more you put into it, even small amounts, the faster you will pay it off. Even an extra $20 per week can make a difference. But remember, it doesn't have to be an elephant. You can choose a smaller loan that you can get through faster, even if that means buying a house outside your favourite area. If you can, get a home loan that you can pay off within 5 to 10 years. The smaller the mortgage, the less overwhelming, the faster you will pay it off, and the more money you save. Buy within your means to pay it off faster. That way you can. Now you might be wondering, how do you work out what is within your means? Don't worry, I'll get to that soon. Chapter 6. How much do you want to borrow? By deciding for yourself how long you want to make repayments for, you remain in control. Don't let your loan control you. Control it from the start by determining for yourself how long you are willing to repay it for. In Chapter 4, I mentioned there were 2 more important questions to ask yourself. Once you know how long you want to take your home loan out for example, 5 years, you need to ask yourself 2 more very important questions. These are: Question 1. How much can I repay regularly? Per week, fortnight, or month? And question 2. How much can I borrow in order to pay it off in that amount of time? When you make the commitment to borrow only what you can repay in that amount of time that you want to pay it off in, then you remain in control. You decide how much you want to borrow. You decide how much you want to repay. You decide how long you want to have your loan for. And you decide how much interest you want to pay. You decide. Then you can start working towards creating your strategy to create a plan for how you can achieve this. Now, you might be wondering, okay, but how do I work out the answer to those 2 important questions? Before we get into that, there are a couple of other areas to keep in mind. Chapter 7. Prioritize. What is most important to you? Before you work out how much you can afford to repay, you can start to set some home loan goals that will also help you to determine how much to borrow. Go back to your why. Think again about why you are buying. If you are buying a first home, this is generally not a forever home. This is the one to help you get started, to set you up in life. Take a moment to rethink the locations you are looking to buy in. Which locations would allow you to buy a property with the savings you have? We bought our first property over an hour's drive from where we wanted to buy, but we bought there because that's where we could afford at the time to be able to pay our home loan off in 5 years. Now, it wasn't all bad. We were closer to family, and we were in an area we were reasonably familiar with. It took my husband hours to get to work and back, but we did it anyway. When we bought, it felt like it would take forever to move back to our ideal location. In the end, it went so fast, it was like we never left. We purchased a property that was within our means to pay off in 5 years, and that made it all worthwhile. Sometimes you have to move out of your preferred location to get ahead. That was the best option for us at the time. Write down areas outside of your ideal location that you would consider buying in. Areas that may be within your price range, that you would feel comfortable living in, but you may not have considered before. As you write these down, circle the ones that you would actually consider buying in. As you search for properties, start including those areas in your search for properties. If you already have those in your search, see if you can find other areas, like surrounding areas, that you may be willing to consider, and then add those to your search too. Chapter 8. What other compromises are you willing to make? Buying within your means isn't just about buying in outer rim suburbs. For example, are you willing to purchase a smaller home, a single story as opposed to a 2-story, a semi-terrace, duplex, townhouse or villa instead of a standalone house, or an apartment instead of a house? How about yard size? Do you have to have that garden or big lawn that may be difficult to maintain? Are you willing to let some of these go for easier maintenance? How about a garage? Do you have to have a garage, or would you be willing to buy a property with a carport or driveway instead? What other compromises are you willing to make? Be realistic with what you are looking for and what you are really willing to compromise. We opted for a single-storey home in an outer rim suburb with a small and easy to maintain yard when we purchased our first home. Based on your answers above, what are you willing to buy? Chapter 9. What incentives exist for buying a home? At times, there are maybe government or developer incentives to buying. At the time we purchased our home, there was a government incentive for first home buyers where you did not have to pay stamp duty on properties under $500,000. So we decided early on that we would purchase for only under $500,000 and therefore not have to pay stamp duty. Since then, we have seen more incentives, either through developers or through the government, where you do not have to pay stamp duty if you bought land, even if you're not a first home buyer. It is well worth researching if there are incentives in your areas of interest for buying, particularly if you are a first home buyer. What incentives are there for buying a first home? Are any of these relevant for your situation? Note, always check official government websites to make sure the incentive you hear about is not a scam. As you investigate these, ask yourself, are any of these relevant to my situation? Go on, do your research and write down any that may be relevant for you. What government or other incentives exist for first home buyers? I won't keep you any longer. Let's get into one of the most important areas to paying your home loan off faster. Calculating. Step 2. Calculate. Interest on debts grow without rain. Quote Yiddish proverb. Chapter 10. Be strategic and realistic. Whilst your lender will determine the maximum amount of money they would be willing to lend you based on your ability to afford minimum repayments over a 30-year term, savvy borrowers calculate their own limits and know themselves what they can afford. By calculating and planning to set your own limits, you will be in control of your own home loan. You will choose the most suitable loan for you, and you will achieve the greatest value in a loan. How much can you really afford to repay? The limits that you establish for yourself can be determined by knowing how much you can repay per week, fortnight, or month. Look at your income and determine how much of your income you can afford to pay towards your home loan on a regular basis. But before we get started, answer this question. How often do you get paid? Or if you are buying with someone else and they are the regular income earner, how often do they get paid? Is it every week, every fortnight, or every month? How often you get paid determines when you will be making repayments. From here on in, when you are asked to calculate something, use the answer you just gave. If you get paid weekly, work out your repayments on a weekly basis. If you get paid fortnightly or monthly, use that to work out your repayments. Next, you might be wondering, how much should I be paying towards my home loan? There are just 2 more important questions to answer before we can answer that question. Question number 1. How much do you earn? Only you know how much you earn on a regular basis. If you do not always earn the same amount, base it on the minimum you earn on a regular basis. Bear in mind, when you do apply for a home loan, your lender will always ask you for your last 2 or 3 most recent pay slips, and they have to be consecutive. If you get paid weekly, they have to be from the last 2 or 3 weeks. If you get paid fortnightly, they have to be from the last 2 or 3 fortnights. If you get paid monthly, they have to be from the last 2 or 3 months. We learnt this the hard way with my casual wage when I did not have consecutive pay slips. I'll tell you about that later. When you apply for a home loan, you must be able to provide evidence that your earnings are what you say they are for 2 or 3 consecutive pay slips in a row. How much do you earn after you pay tax? And how often do you get paid? Write that down somewhere. Question 2. How much are your future expenses? Household bills can put a big dent into your home loan repayments, so you need to work out how much that will be before you commit to your repayment amount. We were renting at the time we purchased, so we already had the usual household bills and could account for those extra future costs already. The only extra regular repayment we would have to make was purchasing our home and contents insurance each year. If you are lucky enough not to be paying household bills, working out your future bills could come as a nasty shock. The most regular household bills are grocery bills, home and contents insurance, electricity, gas, water rates, council rates, internet and or home phone bills, mobile or mobile data bills, car registration, servicing fees, car insurance and associated car running and maintenance costs. Strata, if you purchased an apartment, townhouse, villa or a home in a community area. Land tax, if applicable. Property maintenance costs. You may even have other household bills that I have not listed here. For example, television subscriptions, gym memberships, retail shopping, holidays, entertainment, eating out, school fees, fees for kids' activities, or childcare. Whatever bills you have or are about to have, you need to estimate what these could be as they will eat into your home loan repayments. Do this before committing to a repayment amount. I have not estimated the cost of household bills in this book, as they are different for everyone. To quickly work out how much your bills will cost per week, fortnight or month, download the free Pay My Bills worksheet on paidin5.com/gifts and estimate your bills per week, fortnight, month or even year. Work it out so that it has the same timing as you get paid, for example, per week, fortnight or month. Then write that amount somewhere. Now for the all-important question, how much can you repay regularly? Maybe you already know this. If you use the Pay My Bills calculator, congratulations, you've just worked this out. If not, you can do that now or work it out for yourself. In general, the banks may determine the amount of money you can borrow based on repayments of around 30% or lower of your main source of income. However, if you would really like to get ahead faster, you should aim to make repayments based on somewhere between 30 and 50% of your income, depending on your income and expenses, that you can pay off on a regular basis in a short amount of time. To work out how much you can repay regularly, work out what your income is after you've paid tax and minus your expenses. Note, both the earnings and expenses should either be per week, fortnight or month. Now you have an estimate for how much you could put towards your home loan or other expenses. To work this out as a percentage of your income, Take your savings amount and divide this by your income after tax is paid. Again, stay in the same category for week, fortnight or month to work this out. For example, borrower A plans to repay $700 per week towards their home loan and they earn $1,200 per week. As a percentage, this is repayment divided by income equals percentage of income going towards the home loan. For borrower A, this works out to be around 66% of their income going towards their home loan. That is $700 divided by $1,200. They know that some weeks they may be able to repay $600 and in other weeks they may be able to repay up to $900. But in general, they are confident and feel comfortable that they will be able to repay $700 a week on their home loan the majority of the time. Your situation may be different, and you may only be able to pay 30% of your income to your home loan repayments the majority of the time. For example, maybe you have a lot of bills or expenses. Only you can determine how much you can afford to repay. Use our free Pay My Bills calculator at paidin5.com/gifts to work this out for you. If you know how much you can afford to repay per week, fortnight or month, write down that amount somewhere and how often you can repay this. What if I still don't know how much I can afford to repay? If you are still not sure how much you can afford to repay, look at the last 3 months of your bank statements, or the last year if you can. How much have you saved in the last 3 months or year? This can give you an indication of how much you can repay. For example, if you earned $12,000 in the last 3 months and you spent $6,000, you will have saved $6,000 in 3 months. This leaves you with an approximate repayment amount that you may be able to repay per quarter. To work out for yourself how much you can comfortably repay on a monthly basis, divide the amount you saved in 3 months by 3. For example, $6,000 divided by 3 is $2,000 per month. Note, if you only work this out based on 3 months, this is a very rough estimate only, as you may not have taken into account bills that only happen every year, or new bills that you will receive when you buy a property. So be careful if you are estimating at this cost and based on 3 months, as it is only a rough estimate. Once you have the amount, write that down somewhere and how often you can repay this. To make this estimate more accurate, use the free Pay My Bills calculator at paidin5.com/gifts. Chapter 11. Can you repay more? Now that you have worked out how much you can repay, you may look at this amount and be rather disappointed. You might be wondering, how can I do better? If you are feeling a little deflated or a lot, rest assured, there are options to help you increase this amount. There are 3 things you can do to increase your repayments. Number 1, cut out some of your expenses. Number 2, save on some of your expenses. Or number 3, earn more money. Let's look first at cutting out some of your expenses. Number 1, cut out some of your expenses. If we are honest with ourselves, there are usually ways we can cut out some of our expenses. The most obvious expense you can cut is rent. If you are planning to move into the property you purchase, this will free up rental money for you to put towards your home loan. For example, if you pay $250 in rent per week, this works out to be approximately $13,000 extra that you can repay on your home loan per year. When we purchased our first home, we were paying approximately $400 per week in rent for a small one-bedroom apartment. Once we moved into our own property, this money was going to us. If you currently pay rent and plan to move into the property you purchase, and if you haven't already taken your rental amount into account in the previous section, then you can add this to your repayments. Now you will have a new amount you can repay. Even small additional repayments make a big impact. What other expenses can you cut? Do you buy lunch every day or every week? Store-bought lunches can really drain your income. Lunches can cost approximately $10 each, and that's a cheap lunch. With that in mind, even if you only bought lunch once a week, you could be saving $520 per year. If you bought lunch every day, you could be saving $2,500 every year. It all adds up. That money could be going towards your home loan, and the bonus is that this becomes money you don't have to pay interest on. How about coffee? What about other regular spending habits? Take a good look at your spending. Now, this is going to sound like a lot of work, but it is actually really easy to do and should only take about 10 minutes. Open up your bank account so you can see all of your expenses over the last 3 months or even year. Now create 3 categories. Number 1, essential. Number 2, non-essential. And number 3, I don't know what this item is. Categorize everything you spend according to these categories. Essential purchases are things that you have to buy or pay for. For example, you have to pay your electricity bills. You have to pay your water bills. You have to buy groceries, although this could be lower in some cases. And you have to pay uni or school fees, etc. There are some things you just have to pay. Non-essential purchases, on the other hand, are eating out or buying that new bag for $300 when you have perfectly good bags in your wardrobe already. Open your bank account and scroll to 3 months ago or a year ago. Then look at every item one by one that you have purchased since then. If you don't have access to your bank account, make it a priority that you get access ASAP. You should always have access to your bank account. Every time you reach a non-essential item, write it down and write down the amount it cost. Write it onto the computer, type it into your mobile, or write it down on a piece of paper. Do whatever works for you. As you're going through, if you come across an I don't know what this item is expense, write it down as well. We will come back to this in just a minute. When you have reached the end of the 3 months or year, look at your list of non-essential items and be honest with yourself. Where could you make some savings by cutting out expenses? Or a better question might be, what are you willing to cut out? For example, you may not be willing to forego buying coffee every day or eating out once a week because these are special treats and you want to keep that ritual. That is absolutely fine. You decide where you are willing to cut expenses to put towards your home loan. No one can decide for you, and no one is going to tell you what you can or can't do. It's your money. The more you are willing to cut now, the faster you are going to pay off your home loan, and the less interest you pay on that home loan. It's up to you. So, with that in mind, write down the items you are willing to cut out to be able to repay more on your home loan. Only write those that you believe you could actually do without and are willing to sacrifice. Later, when you review your situation, you may find you are willing to sacrifice more or less. In the meantime, highlight those that you are currently willing to sacrifice and then work out how much you could repay with those items cut. Add this to your repayment amount from the last section and write that down somewhere. Based on all of the repayments from the last chapter and this section, add them up and write them down. As for those, I don't know what this item is expense, how many did you find? A couple? A handful? A lot? Go back through your statements and look at how many times you have paid for these. I don't know what this item is expense. Are they things that come up regularly, or were they a one-off purchase? Try to work out what they could be. If it's regular, maybe it is always an expense that happens on a Friday. Could this give you a clue as to what you are buying? In any case, it's always a good idea to track your spending. There are lots of ways you can do this, but it can be time-consuming and boring. So many people don't bother. At the very least, you should always make an effort to check in on your account once per week or fortnight to look at all your expenses for that period. Some banks even allow you to get notifications for every purchase you make. That way, you can pick up on any suspicious expenses straight away. If you don't already do this, schedule it right now into your diary to look at all your expenses once a week or once a fortnight, or to receive those automated messages from your bank, so you can catch any suspicious expenses immediately. You may even like to check in on your account to check that you have been paid. This will also help you see how your expenses chew up on your savings. Did I really get takeout 3 times last week? And you may decide there are more non-essential items you are willing to forego. Number 2, save on your expenses. When we had our first home loan, we had a nice but expensive to service European car. We live in Australia, so European cars are expensive here. We purchased the car when we had our first baby because we wanted a family car. After we first purchased the car, we had it serviced and the cost was about $2,000. We were told that this was a big service, and a big service like this wouldn't be necessary the next time. We took this as a one-off hit to the budget and didn't worry about it anymore. The next year came around, and what do you know? The service cost around $2,000 again. This time because it needed some repairs. Following this, the car service every year was still around $2,000. This really ate into our mortgage repayments every year. It was our final car service that really took the cake. It was $6,000, and it was in the final year of our home loan. It was then that we said goodbye to that car. We swapped it for a small, reliable and cheap to service car. We've had this car for about 5 years now, and our servicing costs have been about $300 for each service. From $2,000 to $300 was a huge saving. And the difference to our home loan has been huge as a result. There are also other ways you can save money on expenses you already have. For example, can you save on your energy or gas bills? Can you save on interest repayments by choosing another lender? What about your mobile phone or internet bills? Are there other bills that you could be making savings on? Sometimes it also helps to think outside the box. For example, to save money on holidays, we started house swapping. So far, we have saved about $2,000 to $5,000 in accommodation per holiday. Sometimes we have swapped over a long weekend, and at other times we have swapped for 3 weeks. Obviously, it's a great way to save money. And you also get to meet like-minded people, and you get to go somewhere you might not normally have picked, but absolutely love. Or you can choose your destination. You just have to ask. House swapping has become really popular, with lots of places to swap around Australia and all over the world with some amazing destinations. With this in mind, you could put extra money towards your home loan that you would normally spend on accommodation, allowing yourself to go on holidays because it won't break the budget. I wish we knew about this earlier because we actually put off holidaying to save money when we first had a home loan. We didn't start doing this until we lived in our second property. You don't have to miss out on a fun holiday. If this is something you are willing to try, or something like this, don't add how much extra you could save to your repayment amount. Leave this as a bonus for your home loan journey. What are things that you could save money on? Write those down and start making those savings. Number 3, earn more money. The other most obvious way to make higher repayments and pay your home loan off faster is earning more money. Before we talk about this, I must mention, sometimes earning more money can mean more unnecessary stress. And if this is not an option for you, it's okay. When we went through this journey, we focused on reducing spending as opposed to earning more money. That may be your focus too. If you are willing to earn more money and it suits your lifestyle, think about it. Are there ways you could earn extra money? Here are 4 ways you could earn more money. Number 1, are you due for a job promotion? About a year or 2 after our home loan started, my husband got a promotion. This helped to boost our home loan repayments and to pay for new expenses such as preschool. Even changing sectors helped. For example, some state-level jobs pay higher than federal jobs, depending on which state you live in. Bonus! Sometimes private companies pay more than government roles, and sometimes they pay less, but the hours could be longer. You have to weigh up whether it is worth it. Look for alternative roles to find opportunities elsewhere. Number 2, could you get a second job? We didn't get a second job. My husband had over 3 hours in travel time to get to work and back every day. Work was just too far away, and it was more important for us to spend any extra time we had as a family, so this wasn't an option for us. But your circumstances could be different, and this could be something that you do in the short term to boost repayments. For example, maybe you don't have kids yet, or maybe you have more free time. I also had casual work that helped to boost repayments. Every little bit helps. Number 3, could you do odd jobs to increase your pay? You know, the sort of jobs people list online that you can bid for. Are there freelancer jobs you could do as a side hustle? We didn't do this at the time we were paying our first home loan off, but I have done this to boost income that little bit after that time. Lastly, any extra money you receive, put it straight into your home loan. For example, if you change jobs and have your leave paid out, put this money into your home loan. If you have a tax return, don't touch that money, put it straight into your home loan. If you must use the money, then take only half or put half into your home loan. It will be so much easier to pay your home loan off or stay ahead if you put this money away. Try not to touch it. Just remember, whatever income you earn, you need to declare, so always leave money aside for tax purposes. What other ways could you earn a little extra money to help with your repayments? Write down any ideas you have for making money, and then for any of those ideas, highlight any that you are willing to try. Any extra money you make is a little extra bonus towards paying your home loan off faster. What will you try? Chapter 12. How comfortable are you in making your repayments? Okay, let's take a step back to how much you can repay. How much can you repay per week, fortnight, or month? thinking again about how much you can repay, and thinking about your income and expenses, choose a statement that is true for you and be honest. Number 1, I can repay this amount comfortably. Number 2, I will be pushing myself to repay this amount, but I'll be able to manage. Or 3, I will be able to repay this amount some weeks, but I won't be able to keep this up regularly or for very long. If you chose 1 or 2, great, let's move on. If you chose 3, lower your repayment amount. Choose an amount like $50 or $100 to lower it by, and then choose an answer again. If you chose 3 again, lower it by the same amount again. And repeat until you can choose either answers 1 or 2. Our repayment amount was $1,200 a week, that on average we could pay back every week. It was on the number 2 scale for us. I will be pushing myself to repay this amount, but I'll be able to manage. Some weeks we couldn't pay the full $1,200, but other weeks we could pay a little more, and on average it worked out to be about $1,200 per week. Now comes the big test. While you are still house hunting, put this repayment amount into a savings or other account that you can't touch over the next 3 months, minus any rent you have to pay. This amount is an amount you can't dip back into. This will give you an idea if that repayment amount was a good choice for your situation. In the next 3 months, if you find that it is quite easy for you to put this money aside, then you could potentially increase it slightly. If you find it is a little challenging but manageable, then keep it the same. And if you find it to be too challenging, for example, you are dipping frequently back into that money, then consider reducing your repayment amount. Working out how much you can repay involves a little trial and error. Test yourself to see if you can make your repayments while you are searching for a property. Then adjust this amount to what you feel you can manage. If you feel at all like, I'll be able to repay this amount some weeks, but I won't be able to keep this up regularly or for very long, this is a sign to decrease your expected repayment amount to what you can manage. Only you know how much you can repay. Next up, it's time to start understanding what you will really be repaying. Chapter 13. Understand what you will be repaying. We borrow money to satisfy our desire to buy what we want. For example, a house, a car, a holiday, a wedding. But when we take out a home loan, we borrow the amount we need and pay it back with interest applied on top. If we are not careful, it can lead us to paying almost double or more for our initial purchase. Understanding the basic principles of a home loan can help you achieve value from a loan and allow you to be able to make an informed decision, saving you thousands of dollars in the long run. What is a loan? A loan is basically an amount of money you borrowed, which is to be repaid through regular repayments with interest applied. 5 key words. Here are a list of common words you will see used by lenders. Number 1, principal. This is the amount of money borrowed that you have to repay. Number 2, interest. This is the fee you pay for borrowing money. Number 3, lender. This is who you borrow money from. Number 4, borrower. That's you, the person borrowing the money. Number 5, term. This is the length in time of the loan. When you make repayments on your home loan, you'll be paying off both interest and principal, unless you are on an interest-only loan. Repaying interest. Interest is the money you will never see again, also known as dead money. To pay your home loan off faster, you want to pay as little of this as possible to be able to get through the amount you borrow faster. One of the secrets to paying your home loan off faster is to start with large repayments to really reduce your interest repayments when your loan is at its highest at the beginning of your home loan. This will help you to reduce how much you owe overall. Keep this in mind when lenders offer you interest-only periods on your home loan. Interest-only periods tend to be taken at the start of a loan when your loan is at its highest. If you can help it, never, never, never pay interest only. If you do, you'll have to make higher repayments after the interest-only period finishes, and you'll end up paying a lot more interest than you need to. The only exception to this is if you are an investor, but this still comes with other questions. If you do make interest-only repayments, you'll have to make higher repayments after the interest-only period finishes, and you'll end up paying a lot more interest than you need to. If you inadvertently end up on an interest-only loan, which we did on our second loan, I'll get to that later, then make extra repayments regardless, so long as there are no fees for making those extra repayments. Once you understand what you will be repaying, it's time to start taking advantage of this. Next up, we talk about paying more of your principal than interest, and we have a special rule to help you work this out quickly. Chapter 14. Pay more off your principal than interest. Okay, this is the point when we really need to start thinking. When you make repayments, a higher percentage should go towards the principal than interest. Regardless of how long you want to pay your home loan off for, there's only one important point you need to know here, and this is it. At the beginning of your home loan, however long or big your loan is, pay more towards your principal, the amount you borrow, than the interest you pay. This is the 50% rule. When you make repayments on your home loan, more than 50% of your repayment should be going towards your principal, and less than 50% of your repayment should be going towards the interest. For example, if you are making repayments of $1,200 per week, more than $600 should go towards your principal, and less than $600 should go towards your interest each week. A quick way to work this out, if you already have a home loan, is to look at how much is taken out in interest each month. Your monthly repayment would then be slightly more than double that amount. For example, if your interest is $500, your repayment, principal and interest together, would be more than $1,000. Paying more towards your principal at the start of your home loan is an effective way to get ahead faster, whether you pay it off in 5 or 15 years. Principal to interest split. Once you have worked out how much you can repay, an ideal principal to interest split that will help you to repay your home loan off faster is somewhere between 60 and 80% of your repayments going towards the principal, and between 20 and 40% going towards interest. To work out what your principal to interest split is, divide the interest you pay in a month by your repayment. That's your principal and interest together. Then multiply this by 100. This will give you the percentage of the interest part of the split. For example, if interest was $300 and your repayment was $1,200, $300 divided by $1,200 equals 0.4. Multiply that by 100, and that equals 40%. Your interest part of the split would be 40%. To work out your principal part of the split, take 100% and minus the percentage of interest split. In this case, it is 100% minus 40%, which equals 60%. So your principal to interest split would be 60% to 40%. This is worked out for you when you use our calculator, free to use at payidin5.com. If you can, avoid spending more than 40% of your repayments on your interest. When a greater percentage of your repayments go towards paying interest, it becomes very difficult to pay off your debt. You could end up paying more than double what you borrowed in the first place. And yes, your home may double too, but that is no excuse to lose sight of where your repayments are going. And if interest rates rise, the chances of foreclosing on the loan would be high, and you could lose everything. In particular, do not even entertain the idea of a loan in which over 50% of your repayments will go towards interest. If you must have this property, get a second job or a second regular income that will help you to reach over 50% of your repayments going towards the principal. A loan in which 50% or more of your repayments are going towards interest instead of principal is a high-risk loan, unless of course you are an investor, particularly in Australia, then that is a different story. For a house that you live in, aim for between 60 and 80% of your repayments going towards paying your principal off. If you are a first home buyer, if you would like to pay your home loan off faster, or if you are using your home as a stepping stone to your next property, aim towards a principal to interest split of about 80 to 20%. When you do this, it becomes possible for you to pay your loan off very quickly and allows you to save faster. Our first home loan was an 80 to 20% split. Our repayments were $1,200 per week, with approximately 80% of our repayments, over $900 per week, going towards our principal, and approximately 20%, over $200 per week, going towards interest. An 80 to 20% split can help you to pay your home loan off very quickly. The greater the percentage that you can pay off your principal with every repayment, the faster you will pay your home loan off, the more money you will save, and the less you will pay in interest along the way. Now, you might be wondering how to work this out. Don't worry, we have a calculator that gives you this. It is free to use on payidin5.com/gifts. I'll come back to this principal to interest split again later. In the meantime, it's time to start thinking about how much interest are you willing to pay? Chapter 15. How much interest are you willing to pay? Once you have worked out why you are buying, how long you would like to take your home loan out for, and how much you can repay, you can also work out how much interest you are willing to pay for a property. Yes, that's right. Ask yourself, how much interest do I want to pay on this home loan? Do you want to pay under $50,000 in interest, or under $70,000, under $100,000? How much are you willing to pay? You may find that when you look at the figures for how much it will actually cost you to borrow money, the amount of interest you end up paying may be more than you are willing to pay. Think about the value of the property you would like to buy, the amount of money you are borrowing, how long you would like to live there, and how long it will take for you to repay. You may not be willing to pay much interest on your first home, so that it allows you to pay your home loan off faster and move into your favourite location sooner. On the other hand, you may be willing to pay a little more interest for a property that you know you will be living in for a longer period of time. If you are purchasing a home that is only a stepping stone to another property, aim to pay a low amount of interest, for example, under $50,000 or under $100,000, and aim to pay it off over the shortest time frame possible. On our first home, we aim to pay approximately under $50,000 in interest in those 5 years. The amount you are willing to repay in interest and how long you would like to live in a property for is up to you. Only you can decide this, and only you know how much you can comfortably repay in that time. If you're not sure how much interest you want to pay, don't worry. We'll get to that in the next chapter, chapter 16. In chapter 16, we will start to use our very own reverse home loan calculator that helps you to think about your home loan in reverse. This calculator can help you to decide how much you want to borrow and gives you the total interest you will pay over the life of the loan, as well as in the first week, the first month, and the first year. Use that calculator to help you decide how much you are willing to pay in interest. Then play around with the calculator. For example, how much is the total interest if you took 1 year less to pay off your home loan? Or 1 year more? How much less or more would it cost you in interest? Let that help you decide what you are comfortable repaying in interest. In the meantime, write a rough number of how much interest you think you would be willing to repay, and write that amount somewhere before you start calculating. If you are still not sure, let's move straight on to chapter 16. Oh, this is exciting. The next chapter is my favourite. It's what this book is all about. Chapter 16. How much can you borrow? So you've worked out how much you are happy to repay, and you know how long you want to take your home loan out for. But what about how much you want to borrow? How much can you borrow to pay your home loan off in 5 to 10 years, or however long you want to take it out for? The ultimate answer is up to you. Use the calculator as a guide to work out how much you can borrow. But in the end, it's up to you to decide how much you want to borrow given your situation, how much of a deposit you have, the current market trends, for example, interest rates, property prices, and how much your lender would be willing to lend you. If you already have a home loan, it's not all lost. You can still use this calculator to plan how much longer you want to pay it off in. If you don't have a home loan yet, this is where it starts to get interesting. I created the reverse home loan calculator specifically for this purpose. I created it because there was nothing like this in the market at the time, and it's what I wanted to use. It's how I wanted to work out what we could borrow. It helps you to work out the maximum amount of money you can borrow if you know, number 1, how much you can repay per week, fortnight, or month, and number 2, how long you want to repay your home loan for example, 5 years. This was not a calculator I had found anywhere else. I mean, who's going to give you the formula to work out for yourself your own maximum home loan based on how much you can repay and how long you want to take your home loan out for? Who would give you the calculator that lets you be in control? This calculator also gives you the total interest you will repay in that time, so you can work out if this fits with your own desire for how much interest you are willing to pay. Plus, it has another inbuilt feature, the principal to interest split. Remember that from chapter 14 where we talked about the 50% rule? That's in there too, so you don't have to work it out for yourself, and you don't have to be a math guru to know how to do it yourself. You're welcome. To start using the calculator, this is free to use. Go to paidin5.com and look under calculator, or go to paidin5.com/gifts to download an Excel version of the reverse home loan calculator. This is free to use. Check it out. I use it all the time. But I must warn you, it can become a bit of an obsession when you start playing around with this calculator. Before we purchased our first property, I used it so many times to check and double check how much we could borrow in order to pay our home loan off in 5 years. And that's exactly what I hear from people who I share it with. They check and double check and refine what they want. They refine their goals. Once you've opened the calculator, type in how much you can repay and over which period, per week, fortnight or month. Add in the current expected interest rate or one your lender gave you. Don't worry if you haven't spoken with a lender yet. We'll get to that soon too. I always add an extra % or two to the interest rate estimate to give myself a conservative or more realistic estimate of a home loan in case interest rates rise during that period. This will give you a bit of a buffer. And then add in the number of years you want to pay your home loan off in. And voila, it's that easy. There you have it, the maximum home loan amount you can borrow if you want to pay your home loan off in a certain number of years, based on how much you can repay regularly. Isn't it great? I know I am a bit biased because I made it and I use it all the time, but I really just love it. When you create your own personal maximum home loan amount based on what you can repay and how long you want to pay it off for, you remain in control. What if the total interest is too high? If the total interest you would pay over the full life of the home loan is higher than you would like it to be, consider, number 1, paying off the same home loan amount over a shorter period of time, for example, -1 or 2 years. If you do this, you need to be realistic. Ask yourself, would you be able to meet the repayments necessary to pay it off in that shorter amount of time? Or, number 2, get a smaller home loan. What if I want to borrow more money? Thinking about your maximum home loan amount. Is your maximum home loan amount an amount you are happy with? Were you hoping for more? Were you hoping to buy a bigger property? If you are not happy with the maximum home loan amount, or you think it is too small, you can, number 1, increase your repayment amount if you know you will be able to do this in real life. Remember when I asked you where you might be willing to save money? You might want to revisit this section to see where else you could save. You see, there was a purpose for doing that. Number 2, you can increase the number of years you would like to pay it off for. You can even increase it by half a year. For example, 5.5 years, 7.5 years. Or you can increase it by a full year. It's up to you. Or maybe you want to take it out for longer. In any case, if you want to increase your maximum home loan amount, you can do that. Just be mindful that if you do increase the number of years you will pay it off in, it will take you longer to pay your home loan off, and you will be paying more interest along the way. So keep an eye on that total interest paid on the calculator, and keep an eye on the principal to interest split. Go on. What are you waiting for? Give it a go at payitin5.com and come back to write down your maximum home loan amount. Now you might be wondering, what if I already have a home loan? Coming up next in Chapter 17. Chapter 17. What if I already have a home loan? If you already have a home loan and you know how long you want to pay your home loan off for, we have a how long and normal home loan calculator for you, free to use at payitin5.com. The How Long calculator can help you to plan if you already have a loan. These are special versions of home loan calculators. They give you the principal to interest split, as well as the amount of interest you will pay in the first week, month, year, and full life of the loan. The How Long calculator works out how long it will take you to pay your home loan off, and you can play around with the calculator to see how the time changes if you increased your repayments. It's a good little motivation. If you have already worked out how much you can repay, that's great. That will help you work out how long it will take you to pay off your home loan. If you are not happy with the length of time, try to find ways you can save or earn money to help speed it up. Go on, try our How Long calculator and let it help you work out how long you want to pay your home loan off for. Coming up next, we talk about budgeting and additional costs when you buy. Chapter 18. How to budget for additional costs when you buy. What we have been doing up until this point is working out your maximum home loan and how much you can repay. But when looking for a property to buy, it is easy to become attached to places that are just shy of your intended budget. We tend to want the bigger, better options immediately. And if offered enough of a loan to achieve the better property, it is very tempting to take the amount of money a lender is willing to give you and to forget about your own maximum loan amount. It is easy to lose control of how much you really have, and you may find yourself in more debt than you had planned or want to be in. How much will it cost to buy a property? There are numerous costs that creep in when you buy a property. In Australia, some of the most common costs of buying a home include stamp duty tax, property valuations, legal fees, home and contents insurance, property surveyor fees, building and pest inspections, and mortgage insurance. All, more, or only some of these listed costs may be relevant to your situation. For example, you may not need a property surveyor. These could add up to be $10,000, $20,000, $30,000 or $50,000, or maybe even more on top of the cost of the property. Acknowledging what costs may apply to your home loan when you buy will ensure you budget for all costs and stay within your limits. Make a list of all the possible costs when buying a property and add them up. You can even work out how much your stamp duty is going to cost you. This is an important step to working out how much you can spend on a property. All these expenses add up. If you're not sure how much stamp duty will cost, add together your maximum home loan amount plus your savings, and then go to an online stamp duty calculator to work out the stamp duty on that amount. For example, if your maximum home loan amount is $300,000 and you already have $150,000, work out the stamp duty for a property that is the sum of those two amounts. $300,000 plus $150,000. That equals $450,000 to give you a rough estimate of stamp duty costs. Now, this won't be the amount that you purchase a property for because you have to take into account those extra costs, but it gives you a rough guide. Add up all of your possible costs and write them down. Coming up next in Chapter 19, we'll get to a more clearer picture on how much you can spend when we talk about your buying budget. Chapter 19. How to work out your buying budget. Now that you know the cost of additional expenses and the amount you can borrow, and of course, you know how much you have in savings, it's time to calculate your budget for buying. Remember, while you are in the process of buying, you will save more money, so if it takes you a few months or longer to buy, that's more savings in your pocket to play with, and hopefully house prices haven't risen more than that amount in the meantime. Sometimes they do, sometimes they don't. But wait, there's one more thing to consider before working out your budget. Give yourself a buffer. How many times have we heard the saying, save for a rainy day? And why? Because, well, life happens. Unexpected expenses may arise when you buy a property. For example, when we purchased our first property, we had 2 extra repayments that we were not expecting. The first one, we had to pay the extra value of the home, which was $12,000. The second one we had to pay, there was a shortfall in a first home buyer's incentive that we also had to pay, and that was $7,000. On our second property, we had different issues, this time with rising damp in the kitchen. This caused all sorts of respiratory issues for our whole family, so we had to deal with this immediately after moving in. We found out the cause and put a stop to it. Friends of ours have had similar situations when buying. Broken sewage pipes, leaking roof, broken pipes behind the shower or in the bathroom, broken fence, and the list goes on. These end up becoming immediate expenses that you have to deal with and pay for. So what do you need to do? You need to give yourself a buffer, an extra amount of money that doesn't count towards your deposit. Give yourself a buffer of between 2 and 5% or more of the property value. We gave ourselves more than $20,000 as a buffer on both properties, just in case. And we needed to use our buffer in both cases. Working out your buying budget. So let's work out your buying budget now. Take what you have saved, your deposit, add the amount you will borrow, minus your buffer, minus the expected additional costs, such as stamp duty and fees. That will give you your buying budget. Your deposit plus your loan, minus your buffer, and minus the fees you expect to pay. For example, you might have a deposit of $100,000, a home loan of $250,000, a buffer of $20,000, and additional costs of $15,000. $100,000 plus $250,000 minus $20,000 minus $15,000. That gives you a buying budget of $315,000. Try this example for yourself and try it for yourself too with all your own amounts. If you'd like this to be worked out automatically for you, head to paidin5.com/gifts. In there, you'll find the My Buying Budget tool. Use that to work it out automatically. And remember to use the password 1234 to access this too. It's free, of course. If you are about to take out a loan, Read on as the next step incorporates what we ourselves learned along the way when meeting with lenders. I have prepared a range of questions you can use when you meet with the lender yourself. You're welcome. Before you meet with your lender, it's important to understand how to make the most of your home loan, coming up next in Chapter 20. Step 3. Borrow. Worry is the interest paid by those who borrow trouble. Quote by George Washington. Chapter 20. How to make the most of your home loan. When I was in my early 20s, although I already had a loan, a university loan, I hated the thought of having it or any other loan. I especially hated the thought of paying the banks hundreds of thousands of dollars in interest on the one purchase, and the thought of spending 30 years to pay it off. If you start to understand what makes a loan so cringeworthy, you can start to unpack how you can make the most out of your home loan because, well, if you're like me, there's just no avoiding getting one. Paying your home loan off faster all boils down to 3 factors. Number 1, the amount you borrow. Number 2, the interest rate applied to a loan. And number 3, how long you take to pay it off. These 3 factors ultimately determine how much you will end up paying to borrow money. Let's look at these separately. Number 1, the amount you borrow. How does the amount you borrow determine how much you pay to borrow money? Take an example of 2 borrowers, everything being equal except the amount they borrow. Borrower A and borrower B take out a home loan over 30 years with an interest rate of 7%. Borrower A takes out a home loan of $250,000 and borrower B takes out a home loan of $300,000. At the end of 30 years, borrower A, who borrowed $250,000, will have paid about $350,000 in interest, and borrower B will have paid about $420,000 in interest. Borrower B ended up paying almost $70,000 more in interest than borrower A, yet they had the same interest rate, 7%, and borrowing time, 30 years. The only difference was the amount they borrowed. Borrower B paid $70,000 more in interest, even though they only borrowed an extra $50,000. It all makes a difference. The more you borrow, the more interest you pay. Number 2, the interest rate applied to a loan. How do interest rates determine how much you pay to borrow money? Interest rates also make a difference. Let's take borrower A for an example, who takes out a home loan of $300,000 over 30 years with an interest rate of 7%. At the end of 30 years, borrower A will have paid about $420,000 in interest. In contrast, borrower B takes out the same home loan amount, $300,000, and also over the same term of 30 years, however, with a higher interest rate of 8%. At the end of the 30 years, borrower B will have paid almost $500,000 in interest. As you can see, borrower B ended up paying over $70,000 more in interest than borrower A, yet they borrowed the same amount of money. The difference this time was the interest rate. The higher the interest, the more interest you pay. It is very easy to forget what interest rate you are paying and to put up with the current rate when better rates are on the market. I am guilty of doing this too. But the interest rate matters. Try to schedule a yearly check for interest rates. It's not hard to do. When we have so many other competing priorities, looking for new interest rates or negotiating a better interest rate just doesn't get done. You could schedule your yearly check on the anniversary of purchasing your property, or at the end or the start of the year, or maybe you prefer to check around your birthday. Whenever is convenient for you, try to add this to your yearly schedule so that you can keep on top of interest rate changes and interest rate discounts with other lenders. Number 3, how long you take to pay it off. How does time determine how much you pay to borrow money? Let's now consider that both borrowers A and B take out a home loan of $300,000 with a 7% interest rate. However, this time, borrower A takes out the loan for a full 30 years and borrower B takes it out for 25 years. At the end of 30 years, borrower A will have paid about $420,000 in interest, while borrower B will have paid about $340,000 in interest, plus enjoyed 5 years of doing whatever they wanted with their earnings. As you can see, borrower A paid over $80,000 more in interest than borrower B, even though they borrowed the same amount of money, and the difference was only by 5 years. Even paying your home loan out in 25 years makes a difference in comparison to 30. Every year less in paying your home loan off is more money that goes back to you. The longer your home loan, the more interest you pay. Now let's imagine if a new borrower, borrower C, came along and paid it off in 10 years. They will have paid about $120,000 in interest, saving over $300,000 in interest, and having 20 years to use their money in whatever way they please. If you can pay your home loan off in 5 years, you really save a lot. For every 1 year less that you pay on your home loan, you can save thousands of dollars. To pay it off in 5 years, you save hundreds of thousands of dollars. Even 10 years can save you hundreds of thousands of dollars. The longer it takes to pay off your home loan, the more interest you will pay. So get cracking on paying it faster. Every year when you schedule a time to check on your new interest rates, also reevaluate your home loan and see if you can add an extra $100 or more per month into your home loan to see if you can pay it off even faster. Use our How Long calculator to help you work this out. How to make the most out of your home loan. There are 3 important points to take from this. Number 1, get as small a loan as possible to begin with to allow you to pay your home loan off faster. Number 2, try to negotiate the best value interest rate throughout the entire life of your loan, and don't be afraid to continue to negotiate during your loan cycle. And number 3, try to pay your home loan off as quickly as possible. Every little bit counts. To understand some of the different types of home loans available, head to Chapter 21. Chapter 21. What types of home loans are available? There are usually 3 options available to borrowers on paying off their home loan. These are number 1, variable home loan, number 2, fixed, and number 3, a combination of variable and fixed loans. All 3 options contain advantages and disadvantages. We will consider some of these here. Number 1, variable. A variable interest rate is an interest rate that changes throughout the term of the loan in line with market interest rates. The main driver of market interest rates in Australia is the Reserve Bank, who set the cash rate. In other countries, this would be the respective central bank, and the data for this can be found on the web. If you have a variable interest rate, it's a good idea to keep an eye on the changing rates set by the Reserve Bank or the respective central bank for your country. This is because, generally speaking, changes to the official cash rate by the Reserve Bank can change the interest rate that a lender gives to you, which in turn may increase or decrease your interest rate. For example, if the Reserve Bank of Australia reduces the cash rate from 6% to 5.75%, lenders may then be influenced to change their market interest rates in the same direction, which in this example is down. But this may not always be the case. Lenders may keep their interest rates on hold, or worse, increase it even though there is a decrease by the Reserve Bank. The variable interest rate home loan is considered to have, on average, lower starting interest rates compared to fixed interest rate home loans, but not always, so keep an eye on this, as the risk associated with changes to the interest rate is transferred from the lender to the borrower. For example, a borrower with a variable interest rate home loan will wear changes to the interest rate. When the interest rate rises, you pay more, and when the interest rate goes down, you pay less. The advantages of a variable interest rate are: one advantage is you can usually make extra repayments, and therefore you may be able to pay your home loan off faster. A second advantage is when an interest rate decreases, you pay less interest, saving you money. A third advantage is that lenders often offer low introductory variable interest rates. And a fourth advantage is you may be able to use redraw facilities. The disadvantages of a variable interest rate are: number 1, your repayments rise when interest rates rise. And number 2, you may experience a decreased sense of security as expenses may change when interest rates change. A honeymoon loan, a variation of the variable interest rate home loan. A honeymoon loan is a variable interest rate home loan that has a competitive interest rate, usually much lower than the average standard interest rate that lasts for a specific period of time, such as 1 or 2 years at the beginning of the home loan. This lower interest rate period is known as the honeymoon period, and after this time, and for the rest of the life of the loan, the interest rate rises back up to a higher rate, sometimes higher than the standard interest rate. Variable rate changes still apply. They simply apply at a reduced interest rate for a small period of time during that honeymoon period. A honeymoon loan can seem very appealing. However, since the honeymoon period only lasts a short time, usually less than 3 years, your loan will default back to a higher rate. If you plan to pay out your home loan over a short period, for example 5 or 10 years, a honeymoon loan may be beneficial for you. If you plan to pay your home loan off over many years, for example over 15 years, a honeymoon loan may not be suitable unless you can negotiate a competitive interest rate once the honeymoon period has finished. Check with your lender. Fixed interest rate home loan. A fixed interest rate home loan is a loan in which the interest rate and repayment amount remain the same for a set period during a loan. When the set fixed period ends, the interest rate changes to a variable interest rate, or it can be fixed again if the borrower chooses. A fixed interest rate loan is considered to have, on average, a higher starting interest rate compared to variable interest rate loans, but not always, as the risk associated with changes to the interest rate remains with the lender. For example, a borrower with a fixed interest rate will not be affected by changes to the variable interest rate. The advantages of a fixed interest rate are: number 1, a sense of security and certainty, as you know your repayment amount is stable for the fixed period. Number 2, it allows you to budget, as you know how much and when to make repayments towards your home loan. And number 3, should interest rates rise, your repayment would remain the same for that set fixed period. The disadvantages of fixed interest rates are: number 1, You may not be able to make extra repayments, so you may not be able to pay your home loan off faster. Number 2, if you want to make extra repayments, they are generally met with additional fees. Number 3, should interest rates fall during the set fixed period, your interest rate and repayments will remain the same at the higher interest rate. And number 4, a fixed interest rate home loan is generally not as flexible as a variable loan. Combination of variable and fixed interest rates. Lenders may also offer loan products where the interest rate is split between variable and fixed rates for a given period. This means that one portion of your loan would be fixed, while the other portion would be influenced by variable interest rate changes. One advantage of a combined variable and fixed interest rate is your loan is always partially suited to the economic situation, such as changes to the interest rate. One disadvantage of a combined variable and interest rate is you may not receive the full benefits of a variable or fixed loan. Which loan did we choose? Our main objective for our given situation was that we wanted to make extra repayments on our home loan without being penalised by fees, and we wanted redraw facilities available to us. At the time we were searching for our home loan, a variable interest rate home loan was the only means for achieving this, so that's what we chose. At the time, variable interest rates were also lower than fixed. Should interest rates fall, we would benefit, and should they rise, we would wear the costs associated. We also opted for a honeymoon loan, as we were advised by our lender that if we were to make good repayments over the initial honeymoon period, we would be able to negotiate a better loan thereafter. Check if your lender would do the same before deciding to sign up for one. We were planning to make good repayments, so negotiating again during the end of the honeymoon period was ideal for us. At the end of the honeymoon period, we were able to negotiate a comparable loan again. Your situation may be different, and the market may be different. For example, there have been times when fixed rates have been lower than variable rates. Check the market, analyse your situation, and choose which option suits you the most. A combination of fixed and variable may also be suitable, or simply fixed may be suitable. Whatever loan option works best in your situation works best for you. Try to choose the option that benefits you the most. And when it does come time to buy your property, there is one hidden surprise that may be in store for you. Up next. Chapter 22. Watch out for this hidden surprise when you buy property. In Australia, when you purchase a property, the lender will lend you 80% of the value of a property, unless of course you take out mortgage insurance. More on that and why you should try to avoid it in just a moment. So, as a deposit, you need to be able to pay for 20% of the value of the property plus more. Now you might be wondering, what do you mean plus more? Your lender will lend you up to 80% of the value of the property. The value is not how much you pay for the property. The value of the home that you purchase is the amount an independent valuator who your lender will hire will value your property at, and it can be lower than the amount you will pay for the home. When we purchased our first property, we purchased it at a good price. We negotiated well, and we knew you couldn't purchase a house like it at the time for that price. But when our property was valued, it was valued at $15,000 less than what we paid for it. We were shocked, very shocked. We weren't prepared for a lower valuation, as we had no idea that was even possible. Having never purchased a property before, we didn't know. And how would you ever find out? No real estate agent is going to tell you, come and check out this beautiful property. By the way, it will be valued at $30,000 less than what you are about to pay for it. Well, no real estate agent had ever said that to us before anyway. When a home is valued at less, the lender will still only lend you up to 80% of the value of the property, not what you actually pay for it. You need to have extra income aside to be able to pay for that extra amount you purchase that is above the valuation conducted. You need the 20% deposit plus extra to offset the valuation in case the value is lower than the amount you paid for the property. In our case, we had to have an extra 80% of the $15,000 shortfall, which was $12,000. We had to have an extra $12,000 to pay up front. We were lucky. We had extra money on the side to help us over that hurdle. You could encounter the same issue, so be ready for it. And what if you don't have the extra money? Banks may still lend you more than 80% of the loan if you take out mortgage insurance, but then you really pay for it. What is mortgage insurance? Lenders will happily loan you more than 80% of the value of the property on the condition that you take out mortgage insurance. But this insurance is expensive, very expensive. Lenders will also happily add the additional cost of the mortgage insurance to your home loan, so you end up with a bigger loan. And remember what happens with bigger loans? You pay more in interest over time, and it takes longer to pay off. This does not work in your favour. For example, if the value of the property you purchase is $500,000 and you borrow 95% of the property price, that's $475,000, the mortgage insurance will cost you over $15,000, and that amount will be added to your home loan. So you end up with a loan of $490,000, not $475,000. Since interest accumulates over time, you end up paying for this in the long run. It will take you longer to pay off your home loan, and you will pay more in interest overall. If your interest was 5% and your repayments were $1,150 per week, this is like paying it off for an extra half or full year and possibly paying an extra $20,000 in interest. Because mortgage insurance adds an extra amount to your home loan, if you don't want to take the home loan out for a longer period of time, if you want to stick to your timeline, you will need to make higher regular repayments to pay it off or change your timeline. So, what can you take from this? If you are a first home buyer, try to avoid taking out mortgage insurance. If you can, don't do it. It will make it more difficult for you to repay your home loan faster. Try to stay within your own limits for buying and don't add unnecessary debt to your loan. Next up, we talk about shopping around for a home loan. Chapter 23. It's a cliche, but it's true. Do your research. Whatever your situation, it is important to understand as much as possible about the current loan products and options available so that you are able to make the most informed decision for your situation. Aiming to understand your potential home loan will help you too. Number 1, consider home loans on offer by different financial institutions. Number 2, ask lots of questions. There are no wrong questions. Number 3, make a decision that will help you achieve value. And number 4, pay as little as possible over the life of your loan. Shop, shop, shop around. When you look for a home loan, aim to seek competitive quotes from a range of lenders. obtaining numerous quotes is a great way to start your home loan journey and achieve value. But don't just go for the one with the lowest rate. Sometimes this deal can be too good to be true. Always research the company. Even a quick Google for the news about the company is a good idea. For example, we were considering changing lenders to one with a really competitive home loan. This wasn't one of the major banks, but it was backed by a reputable bank. I then did a little online searching and decided not to go with them because security was not as strong with that bank. What you are theoretically doing is testing the market to see which loan products are available and weighing up the benefits of each one against the other. The best possible loan for you is the loan which achieves your desired outcome at the best possible price for your given situation and from a credible lender. When we first started to shop around, we looked online before meeting with potential lenders. We then met with more than one provider, including bank managers and mortgage brokers. We met with about 5 until we found one we were happy to meet with again. The time you spend to find the most suitable home loan for your situation at the beginning will save you money and time in the future. It pays to shop around to obtain the best loan options available at the time. By seeking competitive quotes, you will offset the agendas of each lender and have a range of options available to achieve your desired outcome. Keep up to date with your home loan searches. Lenders are always releasing new and different home loan products to suit the current market. While you are searching for a home, even if you already have approval for a home loan but have not bought a property yet, it is beneficial to continue to keep up to date with the current range of home loan products available. This is something we learnt along the way. When we first shopped around and obtained prior approval for what we considered to be the best loan at the time for us, we did not find the home that matched our needs and budget. 6 months later, we still hadn't found our home and our loan approval had expired. We initially thought that we could go back to our lender and ask for a new approval. However, the lender advised us that the loan product that we had initially received prior approval for was no longer being offered. We started over again looking for a new home loan and were advised that new loan products would be made available 1 week later. We waited a week for the newer loan products and found a loan that we were happy with. Keeping up to date with loan searches and comparing different loan products being made available is a great way to achieve value and save you money. In the next chapter, we'll talk about why it's important to seek to understand when you meet with your lender. Chapter 24. Seek to understand when meeting with lenders. When you speak with lenders, place yourself in the position that you want to understand as much as possible. This will help you to seek full understanding of what they are offering. After all, you are responsible for choosing the best loan for your situation. Don't let them talk you into a home loan you don't want. You need to understand as much as you can and to choose the loan that is right for you. Ask lots of questions and keep in mind that there are no right or wrong questions. As long as you gain as much information and understanding as possible about your home loan product before you decide which loan and which lender to go with. It is important to gain a full understanding before you sign any contracts. When you get a home loan, you are committing yourself to many years of debt. It takes a long time to pay your home loan off, and it costs a lot of money. This may include time away from your family, friends, the things you enjoy, and making sacrifices so you can pay your home loan off. When speaking with home loan providers, Be upfront. Let them know you are seeking competitive quotes to find the best value loan for your situation, and ask them which loan products they can offer you. Don't take what they are saying for granted. You have to do your own research and calculations. If it sounds like a good deal, calculate it for yourself. Numbers don't lie. Well, technically people can lie with numbers, and numbers can be fudged. But in this case, if you're being realistic about your timeline and repayments when you calculate the numbers yourself, your maximum home loan amount, your repayments, your total interest, etc., then numbers don't lie. But be warned, the numbers may shock you. It is important for you as a borrower to know exactly what your loan will involve. In particular, how long you will be paying it off for, what your repayments will be, and how much interest you will be paying on the full life of your loan. Would you like 5 top tips for meeting with your lender? Coming right up in Chapter 25. Chapter 25. Top 5 tips for meeting with lenders. Tip number 1. Take notes. Bring along a pen and pad to take notes. Of course, you can write notes onto your phone or laptop instead, whatever works for you. This way, you remember what was discussed. You can reevaluate the loan products offered later, and you can think of more questions to ask along the way. A good lender will offer you their notes and wait for you to finish your notes before moving on. You can ask them for their notes and the calculations they've made during your meeting. That's what we did. Then you can cross-check at home that they match your own calculations. Don't worry, we have free calculators on our website, paidin5.com, to help you do just that. Tip number 2. Ask about every loan product available. Some lenders may only show you 2 or 3 loan products when you first meet them. You cannot assume that these are the best options for your situation. Ask to see a list of every loan product they have available. This may be more difficult for mortgage brokers as they have too many, but they should at least be able to show you the many options available on a computer screen. Once they show you all of the products, ask how they differ in fees, minimum loan amount. Some loan products require that you borrow at least $200,000 or some other amount. Maximum loan amount. Some loan products won't let you borrow any more than $500,000 or some other amount. The length of the loan. Interest rate and interest rate changes over the life of the loan. And conditions. There are many different loan types available, all with differing conditions and fees. Some loan products may have monthly fees, while others do not. Some may have redraw facilities, while others may not. Some might give you the option to make extra repayments, while others do not. Others may even have a minimum loan amount that you can take out, or a maximum. Or some may be for new borrowers only. Whatever the conditions, find out what they are so you can find the most suitable loan for you. Tip number 3. Ask them over and over again. Are there any other fees? Once they explain the fees to you, it may seem like these are all of the fees, but the best advice I can give you is to ask over and over again. Are there any other fees? And what other possible fees could arise? You will be surprised by what they remember when you probe them with the question over and over again. No, these are all the fees. As I said, these are all the fees. Oh, actually, there is one other fee. Tip number 4. Take your time and seek clarification. If a lender goes through the information too quickly, that by the time the last point is being discussed, you are still trying to understand what they were first telling you, don't be afraid to ask, what does that mean? Or, can you explain that all again? Talking fast is a trick some salespeople use to add confusion so that you get overwhelmed and just sign. I remember a salesman came to our door once and told us about new mandatory painted street numbers on the side of the curb. He was talking very fast, so I didn't have time to think, just to listen and say yes. He was going to paint my street number on the curbside with a glow-in-the-dark paint, so when ambulances would try to find us at night, they could. That was the selling point. All for $20. Low enough they could say yes straight away, high enough for them to make a lot of money in a short amount of time. It all sounded very legitimate, but because he was talking fast, I thought, this sounds to me like he wants to make a sale. So I said no, then walked outside to see how many people had these new glow-in-the-dark numbers on their curbside. And I saw that they had convinced about a third of the street. It was probably closer to 80% of everyone who was at home at the time, and that was just one street. In the end, I found out it was a scam. Don't let agents talk you through conditions too fast. Slow them down and ask them to repeat what they said, which will also slow them down. A home loan needs to be understood by you. You need to know what you are getting yourself into. Plus, seeking clarification shows that you are genuinely considering a home loan. One tip for seeking clarification is to repeat back to the lender in your own words what they just said to you. This way, they can say, yes, blah, 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 or no, what I said was blah, blah, blah. Don't be afraid of taking your time to really understand. It's quite amazing what they don't tell you, and we can't assume anything. For example, you might assume it's a home loan you can make principal repayments on, only to find out it's an interest-only home loan after you sign. What a nasty shock. This happened to us on our second home loan. I was not impressed. Or that you will have to take out a credit card with your home loan which you didn't know about before. What? Happened to us too. In the end, we never activated it. Or if you seek to refinance and the lender tells you to do it after signing, so you wait until you have signed and then they tell you, oh, sorry, you can't refinance for at least 6 months. And when you do, you will have to take out another loan. Happened to us too. Grr, 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 and grr. But rest assured, there are some good lenders out there. Good lenders that will be more than happy to explain the conditions of a loan to you again and again and again. Tip number 5. Take a list of questions with you and don't be afraid to ask them. Try to come up with some questions that you would like to ask before you meet with lenders. What do you want to know about your loan? What do you want from a loan? What do you expect from your loan? What do you want to achieve from your loan? Asking yourself these questions will help you to find more questions that you can take to your lender. And what if you had a ready-made set of questions to ask your lender? That's coming right up in the next chapter. 30 questions you can take with you to ask your lender. You're welcome. Chapter 26. 30 questions to ask your lender before signing. The following questions can help you to better understand the loan products you are about to be offered. Here are 30 questions you can ask your lender to get you started in your home loan conversation with them. Of course, add your own questions as well. And why not pop your extra questions into the comments? Question 1. How much can I borrow? Question 2. What are the repayments on this loan? Although you will work out your own repayments, it's good to know your obligations for paying off your home loan from your lender. Question 3. What proof do I need to provide to borrow that amount? Question 4. What is the current interest rate? Question 5. What current honeymoon loan do you offer and what does the interest rate default to after the honeymoon period ends? Don't let them give you a vague answer to this question. Ask them to be specific. Question 6. Am I able to negotiate a better deal during the term of the loan? Question 7. If I wanted to negotiate a better deal, what is the process? Question 8. How long does a home loan run for, or what is the loan term? Question 9. Can I make additional repayments? Question 10. Are there any fees or additional charges for making extra repayments? Question 11. Are there any fees or additional charges for paying the home loan off early? Question 12. Are there redraw facilities available on this loan? Question 13. Are there any fees or additional charges for withdrawing money? Question 14. Can I make interest-only repayments, and how long for? If things get tough due to illness or major life changes, you need to know the available options if you need to use them. Question 15. Can you list and cost all the fees and charges? Question 16. What are the terms and conditions of the loan? Question 17. Are there fees or additional charges for changing loan products? Question 18. Are there fees or additional charges for exiting the loan early or changing home loans? Question 19. Is there an everyday bank account available to transfer the repayments to the home loan account? Question 20. What fees or additional charges are involved in setting up and using such an account? Question 21. What other loan products do you have? Can I see a full list of these loans? Question 22. Are there any new loans which are about to be made available? And when will they become available? Question 23. Are there any other fees? Question 24. Can you check again? What other fees could arise? Question 25. How much does it cost to open an offset account? I'll talk about offset accounts soon. Additionally, you may like to ask questions relating to different scenarios through what-if questions. This may be about any possible situation that may come up during the course of your home loan. By posing these questions in terms of what-if scenarios, it will help you to think about how your repayments will be affected by possible future life events. 5 sets of questions may include: Question 26. What if times got tough and I cannot meet repayments? What are my options and what would happen? Question 27. What if I want to refinance my loan? How would I go about doing that? Question 28. What if I need to take out a small lump sum of my home loan to pay for miscellaneous expenses? For example, car registration, repairing washing machines. Is there a limit on the redraw amount? Are there fees for taking out too much or too little? This seems like a silly question, but you would be surprised. Question 29. What if I wanted to buy another property and take out a large amount of money from my home loan account? What would happen then? Question 30. What if I wanted to buy another property and wanted to use equity? What is the percentage of equity that I can use? And what are the associated fees? By asking lots of questions, you are aiming to gain as much information and understanding as possible about your loan product before you sign the contract. This will help you to choose the right home loan that provides you with the most value and can help you to achieve your desired outcomes and save you lots of money. And here's a bonus question. Question 31. Can I have a copy of your notes based on our chat? Before you go rushing off to your lender to ask these questions, I have 3 key points before you meet with your lender, coming up in Chapter 27. Chapter 27. Buyer beware. 3 key points before you visit the lender. Point number 1. Find out how much they will lend you. Up to this point, I've harped on about how you need to decide what your own maximum home loan is. By now, you should know what that is, or at the very least, you have everything you need to work that out. So, why am I asking you to find out what the lender will give you? When we purchased, we could borrow 80% of the value of the property. We knew what we could afford, so we searched within our means and within our budget. Because we saved enough to borrow a smaller amount, let's say 70%. It wasn't exactly 70%, but this makes for an easier example. We still borrowed the full 80%, but then immediately paid that down to that 70%. On paper, we borrowed more money, but as soon as it arrived, we paid it down so that we were really borrowing only that 70%. And we put that extra amount into an offset account. I'll talk about that soon in step 4. For example, let's say our property was valued at $350,000 and our lender was willing to lend us up to 80% of the property value. This meant we could borrow $280,000. However, our own maximum loan amount was $250,000, a difference of $30,000. So rather than saying, oh no, we want to borrow $250,000, we actually said, great, give us $280,000. And on the very first day that we took out the home loan, we put that extra $30,000 into the offset account and paid the home loan down to $250,000. So our home loan was actually $250,000 on the day we started the loan. Why did we do that? If you borrow more money than you need and you immediately put that money back, don't lie to yourself and take out the bigger loan. You need to know your maximum loan amount and pay it down straight away. Then you have money aside just in case you need it. For example, if this is your first home and you know you want to buy a bigger property or one closer to or in your ideal location later, and you pay your home loan off quickly, you will have slightly more money to be able to use it as a deposit when you choose to buy a bigger home. The aim is to have more cash available to you when you have finished paying off your home loan. Whatever you borrow, you need to be able to pay it down to your own maximum loan amount on the first day of your loan. If you don't, you won't be able to pay your home loan off as fast as you were planning. Point number 2. Never sign the contract that day. After you have shopped around and discussed your home loan with your preferred lender, take home their offer and go over the information again. Do your own calculations. Make sure you have a good understanding of the loan product and you are satisfied with the features. You are going to be stuck with them for some time after all. Some things to take note of are: what is the current interest rate? Is there a honeymoon period, and if so, how long? Are there any credit cards you have to take out to get the loan? Is it an interest-only home loan for a period of time, or can you pay interest and principal? What are the fees? What are the fees for taking out the home loan? What are the fees if you close the account early? What are the ongoing fees if there are any? What are the fees for redraw? What other fees are there? What is the total interest you will pay if you take out the home loan over 30 years? What is the total interest you will pay if you take out the home loan for less than 30 years? And how much are your monthly or weekly, fortnightly repayments? Give yourself some additional time before you sign the contract to go through the contract again. This can help you to raise additional questions, to calculate and recalculate possible scenarios, and to compare each option again fully. Point number 3. Know what evidence you need to provide to get approval on your home loan. And watch out for the casual wage. When we shopped around for a home loan, we went to a range of different lenders who were willing to lend us money. We received our conditional approval and went ahead choosing a home. When we did eventually find a property, we went back to our lender to provide all our documentation. Up until this point, lenders ask you about all your sources of income, of which we had my husband's full-time wage and my casual wage. They plug this into the computer and give you the amount you can borrow. Usually, if you have an extra wage, like a casual wage, together with a full-time wage, this means on paper, you can usually borrow more. If you have a casual wage, like I did, this doesn't seem to be an issue. That is, until you actually have to take out a home loan. A casual wage being a casual wage means that I got paid sporadically. I would get paid 1 week, miss out on being paid for the next 3 weeks, be paid for the 3 weeks after that, and then nothing again for 6 weeks. My pay was all over the place. Because the lender had always calculated my wage based on my yearly income, this didn't seem like an issue. However, when it actually came to buying, our lender asked for 2 consecutive fortnightly pay slips. When it came to getting a home loan, I didn't have 2 consecutive pay slips in a row. I didn't have 2 pay slips at that point in time where I had been paid one straight after the other. I gave them 2 of my latest pay slips, one within the last 2 weeks and one from a month prior. But this was a problem. We couldn't use my pay slips. We couldn't use them at all. I said to our lender, "Well, you know I'm a casual. That's how we get paid." Our lender knew I was a casual from the start. I had 2 pay slips, but I didn't have 2 current consecutive pay slips. The lender wasn't happy. I wasn't happy because we were lured into a false sense of security that we could borrow more money when we couldn't. Because I was also a casual on a 6-monthly contracts, even though I had been employed with the same organisation for about 10 years. I then went through a process of having to get my managers to sign a letter saying that they would keep me employed. This was also embarrassing. In the end, we took my casual wage out of the home loan application because of the issue with the 2 consecutive pay slips and just borrowed money based on my husband's full-time wage. This, thankfully, was able to cover us for about 80% of the property value, which we paid down immediately to our maximum loan amount. We were just lucky that we weren't purchasing a more expensive property, like we thought we could. We had set our own limits on what we wanted to spend, and therefore we were keeping our home loan amount low. This was fortunate for us as we wouldn't have been able to purchase a more expensive property anyway. We purchased within our means, and thus could get the money we needed to buy the property. If we had found a higher priced property on our conditional approval and then purchased that, we wouldn't have received the loan and we would have lost our deposit. If you have a casual wage, be cautious about including it as an income when you speak to lenders. Unless you can present 2 consecutive pay slips at any time that you can produce on notice, then it may be worth the hassle. Opt for a smaller home loan that is more manageable to pay off and easier to approve past the conditional approval. Since purchasing, I have inquired again about casual wages and have been told that some lenders do provide approval for casual wages based on the annual amount. But when I dig down about the evidence you need to provide, it's still the same story: 2 consecutive current payslips. Sometimes even 3. If this applies to you, check with your lender. The same might also apply for people who have their own businesses or are contractors. Whatever your situation, be specific about knowing which evidence you have to provide and ask what alternative evidence is required if it can't be met. Make sure you know what evidence you need to provide when it comes to actually applying for a home loan. In the next chapter, we'll put it all together as you prepare to buy. Step 4. Buy. Things which matter most must never be at the mercy of things which matter least. Quote by Johann Wolfgang von Goethe. Chapter 28. Review your aims. The ultimate question is, how much should I borrow? And the ultimate answer is, it's up to you. You have to decide what is right for your situation. You understand your situation the best, and therefore no one else can make that decision for you. For example, maybe you are looking for your first property, or maybe you are just looking for something to buy so that you no longer need to rent, and buying at the time is cheaper than renting. Everyone's situation is different. In this book, you have already worked out some of your aims regarding, number 1, why you want to buy. Number 2, timeline, how long you would like to pay your home loan off for. Number 3, repayments, how much you can repay per week, fortnight or month. Number 4, maximum interest, how much you are willing to pay in interest. Number 5, other aims, anything else you need to consider when buying. And together, this has helped you to work out your maximum home loan amount. The maximum loan amount you can borrow in order to pay your home loan off in the time you want to pay it off in. For example, our aims were, number 1, our why was to buy our first home, something easy to maintain outside our ideal area and with a small buying budget. Number 2, timeline. We wanted to pay it off in 5 years. Number 3, our repayment amount was $1,200 per week. Number 4, interest. We wanted to pay less than $50,000 during those 5 years. Number 5, other. We wanted to avoid stamp duty, so we purchased a property under $500,000. Our maximum home loan amount was about $250,000. Together with some tips for borrowing, you are now well and truly on your way to buying. Take a moment to write down your aims. Why are you buying? What is your timeline? How much are your repayments per week, fortnight or month? What is the maximum interest you want to pay? Are there any other things to take into consideration? And what is your maximum home loan amount? These goals helped us to determine for ourselves the maximum we wanted to borrow, even if the banks wanted to give us more. Our ideal home loan at the time was approximately $250,000. We stuck to this amount when buying. If you already have a home loan, start to take control of it by determining how long you want to continue with your home loan for and how much interest you are willing to pay during the rest of the life of your loan. Use our How Long calculator, free on paidin5.com, to work this out. Work out how much you would need to repay regularly, per week, fortnight or month, and take action to start meeting those repayments continuously. In the next chapter, we'll take a trip back to your why. Chapter 29. Go back to your why. When we purchased our first home, our why determined that we could only afford a studio or one-bedroom apartment in our favourite area. Actually, even a one-bedroom was out of reach. With a young family, this wasn't realistic for us. To buy a property that we could repay in 5 years, we realised we needed to buy a house outside of our ideal area. We had to move out of the area to buy within our means because we could not afford a big enough property in our favourite location. Once you work out how much you can afford to pay for a property that you can pay within a short amount of time, you have to get real about where those places you can afford are. If you are buying a property for the sake of paying it off in 5 to 10 years, then you are unlikely to be buying your forever home. Get comfortable with looking at places outside of your ideal location. Ours was over an hour's drive from our favourite location, but we knew we wouldn't be there forever. and that time would go quickly. So we made the move and purchased within our means. For our second property, our why changed. This time it was to buy a property in our favourite location. At the time, the interest was cheaper than paying rent, so it didn't make sense for us to rent, and we were happy to take out a home loan for longer than 5 years. We bought the cheapest non-apartment at the time, but it was very small. We joked at the time it was the cheapest home on the market and also the smallest. It really was. We did it because we wanted to buy in our favourite location. It was all we could afford that wasn't an apartment. Go back to your why for buying, as this will determine what you look for and what you buy. If you fail to follow your why, you will aimlessly go to every open home, week in, week out, not really knowing what you're looking for, or buying a property that will not benefit your situation. And just because this book is about paying your home loan off in 5 years, if that doesn't work for your situation, you don't have to do that either. It's okay to pay it off in 7 or 10 years, or anything less than 30 years really. It's up to you. It's your choice. Maybe at the time you are buying, it is cheaper to buy than to rent. It's okay to take longer than 5 years to pay your home loan off. You can still make great savings on a home loan, greater than 5 years. Look at your situation and what will work best in that situation. Every situation is different. Would you like to know what else you can do to be ready to buy? Coming up next in Chapter 30. Chapter 30. Be ready to buy. Before you purchase a home, there are some things you need to organise. Firstly, ensure you have your home loan pre-approval in place. This is the approval your lender gives you to say, all things being equal and true, based on the information you provided, we can lend you X amount of dollars. Once you have your pre-approval, you can work out how much you can spend on a property. Remember to factor in the stamp duty, solicitor costs, and other associated fees, as well as the deposit you have. If you're not sure, go back to Chapter 19. What is your buying budget? Secondly, ensure you have a solicitor or a conveyancer you can contact to review the contract and make any relevant changes for you. Speak to them about their availability for when you plan to buy, so they know when you are planning to buy a property and are around to take on the work, answer any questions, and work through the documentation. The last thing you want to do is buy a property only to find that your solicitor is away on holidays and you need to find another one quick smart, although it can be done if this does happen. Thirdly, do your due diligence and get an independent inspection on your property. We didn't do this on our second property. We purchased an inspection that was conducted by someone working for the real estate company. While this was okay, we learnt that an independent inspection would have pointed out other noteworthy issues about the property we purchased. Check with your independent inspector about whether they move furniture to look at all areas of a property, as sometimes floors will be hidden purposefully behind furniture because inspectors will not move them. You can conduct the inspection before or during the cooling off period. Note that if you do this during the cooling off period, if you find flaws that you are not willing to fix and you decide not to buy, you may lose your holding deposit. Get everything organised so you can go in and make an offer when you find the property you like. Want some great tips on how to get value in a property? That's up next in Chapter 31. Chapter 31. 3 tips to get value in a property. When you have decided on what you want to buy and know your why, it's time to start looking at properties. At times, you will notice in the market that a property sells for less than the market value. That someone got a good buy. Maybe that someone could be you. Your aim as a first home buyer is to buy the property you want for as little as possible because you want to pay it off as quickly as possible. the more money you have to borrow, the longer it takes to pay off. Know your limits for how much you want to borrow and try to buy a property for as little as possible. Sometimes there may be a house that nobody wants that you can get at a cheaper price. This is all well and good if you are happy there. Keep in mind that buying a property that nobody wants to buy also means it will be harder to sell if you did want to sell it later. On the flip side, sometimes the competition is so high and properties sell for well above the market value, and it is not possible to get a good buy. In any circumstance, there are things that you can do to try to get value in a property. Here are 3 tips to get you started. Tip number 1. Find out the estimated property value before you buy. Before you make an offer, search for the property on the internet and look for an estimated property value. This is not always available, but most of the time you can figure it out or find information somewhere about it. Sometimes there is a similar house next door, and if it is similar enough, you can get an indication of the estimated property price range. Look at the history of a property to find out if it has sold many times or has been rented out frequently. Again, this is not always available. Don't be afraid to add your email to real estate agent newsletter subscriptions or ask to be put onto their databases. Sometimes homes are sold off-market or are available to see pre-market, and this makes it easier to search for the history of a property and how much it could be expected to sell for. Tip number 2, scope out the competition. Now, you don't have to do detective work or act weird at an open home. What I mean by scope out the competition is to look at how many people are at the open home. How many people are asking the real estate agent questions? If you overhear conversations with the real estate agent, what are people asking? Are people asking for a copy of the contract? When people chat with a real estate agent, this shows they are potentially interested in the property. It doesn't mean they will necessarily buy it, but they may be interested. If you are legitimately interested, ask for a copy of the contract to be emailed to you. This is usually given immediately, and you may not even need to ask. When you receive the contract, have a look, and if you are still interested, send it to your solicitor to review. Note that you will have to pay your solicitor a fee to review the contract. Or put down an offer and make this conditional on the review of the contract by your solicitor and an inspection. When your offer is accepted, you can engage your solicitor to review the contract. If you're in luck and there are no other buyers, aim low and stay low with your offer. If you really want the property and they won't budge on the price, then you may need to consider increasing your offer. How much you pay in the end is up to you and what you think the property is worth and how much you are willing to pay. If there are other keen buyers, you may need to negotiate the price to get the property you want. Be careful to not go over your own spending limit or lose sight of your own home loan goals during this process. If you go over your buying budget, make sure you are fully aware of what you are committing to. Run the calculations. Tip number 3, think about the time at which you are buying. Some people suggest that you should buy when the market is down, but this can be difficult if the market never seems to really be down. In any case, there is a general rule of thumb that the market tends to be lower at Christmas and in winter. Watch out though, because pre-Christmas and pre-winter are high real estate sales times, as people want to move in before Christmas and before winter settles in. Since entering the property market, we have seen a dip in the property market twice. Once during COVID, which lasted only about 4 months, and once where there was a dip that lasted about a year or 2 and then just crept its way back up again. If you can, buy in the downturn, but don't hold off buying for that time, as you may be waiting 7 years, and then the house prices are so much higher again that it might not pay off for you. If you can predict a downturn and you want to wait for that time to buy, then you may choose to do that. but it does not always pay to wait for a downturn. This book is about paying your home loan off faster. For more tips and information about how to negotiate a good price on knowing when to buy, search the web. There are many resources out there. Research for yourself and decide what you feel comfortable doing. Chapter 32. What happens when your offer is accepted? Paying a holding deposit and signing the contract of sale. Once your offer is accepted, you need to pay a holding deposit to take the property off the market. This is usually around 0.25% of the purchase price, 0.25%. For example, if your purchase price is $500,000, the holding deposit will be $1,250. If your purchase price is $1 million, then the holding deposit will be $2,500. When you pay the holding deposit, this is also when you sign the contract of sale. Make sure your solicitor has reviewed the contract of sale before you sign it. You should also read over it too, making sure that the purchase price matches the one you agreed. You are happy with the conditions. You understand the conditions. You understand your responsibility. And you understand your responsibility in upholding the conditions. For example, what are the fees for late settlement? Take a copy of everything you sign. The real estate agent should offer this to you. You don't want to be in for any nasty surprises after signing the contract, so do make sure you check everything first. The cooling off period. Signing the contract of sale and paying the holding deposit takes the property off the market and you enter the cooling off period. This usually lasts for 1 week. During this cooling off period, you can conduct any last inspections if you haven't already, or change your mind about the purchase. If you decide within that week that you no longer want to purchase the property, you may lose your holding deposit, so be sure you want to buy the property before putting any money down or signing any documentation. During this period, get in touch with your solicitor and lender if you haven't already, to let them know your offer has been accepted and you have entered the cooling off period. Your lender will also then conduct an independent valuation of the property to determine how much they can lend you. Remember earlier in step 3, borrow, where I mentioned the surprise of the lower valuation on our first property. This is that time. Make sure you can still borrow enough money to pay for the property even if the valuation is lower than you expect. Your lender will only give you 80%, or another percentage you agreed on, of the value of the property, not how much you pay for the property. The settlement period. After the cooling off period ends, you enter the settlement period when you commit to making the purchase by handing over a second deposit. This is usually 10% of the purchase price, so make sure you are ready with any bank checks if this is required when this happens. Visit the bank or speak with your lender days before to get all of this organised. There could be consequences for making a late payment, so make sure you are ready to go. Then you enter the settlement period. This usually lasts somewhere between 30 and 90 days, and you receive confirmation on your settlement date. Now is when the real work begins. After this, get everything organised and keep on top of what's happening so that you are ready to pay the rest of the property price on your settlement date. If there is one key takeaway to settling on your property, it's coming up in Chapter 33. Chapter 33. Be willing to move mountains to meet your settlement date. During the settlement period, stay in regular contact with your lender, solicitor, and the agent to make sure you are on track for the settlement date, the day where all parties exchange the money and contract of sale for the property. Call your lender, solicitor, and agent for regular updates. Don't expect them to call you. They won't. And they will make decisions on your behalf without first consulting you. Call them anyway. This happened to us on both of our property purchases. What we learnt from buying our first property. A couple of days before we were meant to settle, I called our lender and they told me we had to push the settlement date back by a few days or a week. Now, if ever you have to push the settlement date back, you get hit with lots of fees. And this adds up to a lot of money. You get charged for every single day you are over the original settlement date. Our motto was to never, under any circumstance, push back the settlement date on our side. If the other party must push back, then that is their issue. But on your side, don't do it if you can help it. When we were told we had to push the settlement date back on our first property, I asked why, trying to figure out what had happened. At the time we purchased, there was a $7,000 government incentive for buying under $500,000. The problem was that this $7,000 was not going to be available before the settlement date. In the meantime, our solicitor assumed that we wouldn't have the $7,000 to cover the costs that the government grant was originally going to cover. So our solicitor called for the settlement date to be pushed back, without consulting us first. Nobody consulted with us. Nobody called us. Nobody communicated with us in any way. Nobody even told us there was a new settlement date planned. It was only because I called the lender. Nobody told us until we asked questions, and nobody consulted with us about this issue. And yet they made decisions on our behalf. We did have the $7,000 shortfall, so we pushed forward to settle regardless of the decisions made on our behalf, and we ended up settling on the correct date. Remember when we talked about having a buffer? This is for that reason. On the same property, another issue we faced to potentially push back the settlement date was that the vendor, the person selling the property to us, also pushed back the settlement date. A couple of days before settlement, the vendor wanted to move the settlement period back because they couldn't move the rental furniture out in time for settlement. However, if you are ready on settlement date, you are allowed to move in, even if the vendor is not ready. You can still move into the property on the original settlement date, even if the vendor pushes the settlement date back. You have every right to. If you have moved mountains to meet your settlement date, then you shouldn't have to wear any associated costs, and that includes paying for extra rent elsewhere. The vendor moved the rental furniture out and we settled on the original settlement date. If for any reason the vendor needs to push the settlement date back, then let them. They will wear the associated costs, not you, and you can still move in. If for any reason you are told by your solicitor, lender or agent that you need to push back settlement on your side, then move mountains to make settlement happen. You don't need those extra costs. What we learned from buying our second property. On our second property, 2 days before the settlement date, I was told that our solicitor didn't have all the paperwork. I spent a full day with a double pram and 2 young children in tow, running from one place in the city to another, calling people, paying for documents, organising for this last piece of paperwork to come through. And by the end of the day, I had it. I moved mountains that day to make it happen. Other people are not concerned if your property purchase doesn't go ahead on the day it is supposed to. And why would they? They are not hit with all the fees. You are. I didn't wait for someone else to do it. It would have been too late, and we would have had to pay all those additional fees. I went and fetched the documents myself. I went above and beyond my own role to get what we needed. You have to do whatever you need to do to make it happen. Within the last 5 days before settlement, be prepared to go above and beyond if you need to. If you have to, physically go and pick up and pay for any necessary documents that you need, even if they are hundreds of dollars, even if you have kids in tow, even if it's raining, even if it's hours away, even if it's the day before settlement. Do everything you can to settle on settlement date. And during the process, keep calling your solicitor, lender and agent to get regular updates. If you don't, you could be settling after the original settlement date. and then you will literally be paying for it. This wraps up the buying section of this book. Up next, we start talking about how to manage your home loan. Step 5. Manage. Success is the sum of small efforts, repeated day in and day out. Quote by Robert Collier. Chapter 34. Everyday Habits. When you commit to paying your home loan off faster, it can be very easy to lose track of that goal. 5, 7, or 10 years can seem like a long time in the first 6 or 12 months of your home loan, or even in the first month. Paying your home loan off faster comes down to being mindful about the way you spend and save money, and how you track and adapt to your home loan situation during the life of your loan. Some of this comes down to having healthy money habits. But what is a money habit? Money habits are those little things you do in life when you spend, save, track, or manage money. Everyone buys something. Everyone spends money. It's those habits around how you spend your money and how you look after your money that matters. Those habits might be so automatic that you don't even notice doing them. Like buying something from that delicious smelling bakery you just happen to walk past every day. When you have healthy money habits, you take better care of your money. These habits help you to pay your home loan off faster. They help you save, and they help you manage your money. What are your everyday habits? Everyone can create healthier money habits. Everyone can create better habits in general. Everyone already has some form of helpful habits in their life. These can be completely unrelated to money. The trick is to harness these helpful habits for creating your own healthy money habits too. Think about this. What is something in your life that you commit to no matter what? For example, do you commit to eating healthy on Mondays? Do you commit to exercising 2 or more days per week with specific times that you do that, such as a Tuesday and a Thursday morning? Do you commit to getting to work by 8 a.m. or another time, every day or every other day? Or do you, no matter what, make sure the dishes are done before going to bed? What do you do every day without fail? Everyone has something they commit to without fail, even if it's as simple as getting up and getting dressed. Everyone has little rules or agreements with themselves that they live by, and everyone has different rules or agreements. Everyone has helpful thoughts that motivate them to maintain these rules or commitments. Everyone has them. Everyone has habits. Pre-COVID, once a week, I used to leave for work at around 6:20 a.m. and every time I did, I would see hundreds of people also going to work. Some of these people woke up early to exercise before they left. Some to pack their kids' lunches before they left. Others to study before they set off for work. And others did all of the above. Something got them out of bed. That something was the little commitments they set for themselves to make sure they would leave on time. That something was the helpful thoughts willing them to get up early and go. The little reminders that got them out of bed. Maybe it was a helpful thought framed in a positive way, such as, I need to get up so I can spend more time with my kids and pick them up this afternoon. Or, it's exercise day. I need to get up and exercise before work so I can be in a good frame of mind at work. Or maybe it was a thought that was framed in the negative, but still willing them out of bed or to do something else. For example, if I don't get up, there will be no one at the bus stop to meet the kids at pickup, and who knows what will happen. So I have to get up no matter what. Or, if I don't get up, I will lose my job. Or even, if I don't eat healthy, my trainer is going to make me pay for it. No matter what, there are thoughts continually going on in our minds. Some of those thoughts are helpful and encourage us to do what we commit ourselves to do. Those thoughts can be your motivation. When we understand our everyday habits and we start to look at what motivates us to do those behaviours, we can start to understand what motivates us and how we can use this to establish helpful money habits that can help us to pay our home loan off faster and potentially save hundreds of thousands of dollars. What about our bad habits? Just like good habits, we may have bad habits too. We all have bad habits or unhelpful rules or thoughts that encourage us to skip our commitments or that lead to bad habits forming. For example, letting ourselves miss that exercise class, drinking that extra glass of wine, or leaving the dishes in the sink overnight. We may even have unhelpful money habits that we'd like to do better. The good thing is, we can change them. It is possible to create better habits and break unhelpful ones. Everyone has little rules or agreements or commitments that they live by, and everyone has different commitments. Next up, let's talk specifically about money habits. Chapter 35. Money habits for your home loan. Being mindful about your own money habits can help you to stay motivated, to break old habits, and to create new helpful habits along the way. So, what kind of money habits are out there? There are so many money habits. There are money habits that save you money. There are money habits that prevent you from overspending. There are money habits for almost everything you do in life. I will not attempt to list them all here, but here are some common money habits. Having an accounting habit. Spending time every week, fortnight or month to manage your finances. Only buying clothes on sale. Not using the credit card. Cleaning the house yourself. If something is broken, fix it. You can't buy something new unless you have already sold, donated or thrown something out. If you do your grocery shopping on a Sunday, don't go back to the shop again until Thursday or the next Sunday, or some other rule for grocery shopping less. Doing your grocery shopping after you eat, not shopping on an empty stomach. Paying your bills on time so you receive a discount or prevent late fees. Money habits for your home loan. There are so many money habits and it's often hard to know where to get started. Here are 5 top money habits that are really helpful for managing your home loan and paying your home loan off faster. These habits helped me to keep track of our home loan and to keep on top of our finances. Since they are related to managing home loans, they are accounting habits. Don't let that put you off. You don't need to be a math guru to be able to do this for yourself. All you need is a little know-how and 5 minutes to get going. Here are my top 5 money habits related to paying your home loan off. Number 1, the single most important money habit. I'll let you in on that secret soon. Number 2, open your online banking account. Number 3, look at your income and expenses. Number 4, track your home loan. And number 5, forecast your bills. Choosing a money habit to work on. While my top 5 money habits can be really useful for managing your home loan, you may also have your own money habits that you would like to work on. When you have your own money habits, this can help to motivate you. It can help you to identify what it is you want to work on and what is helpful for your situation. When you do come up with money habits that you would like to work on, there is one important tip to keep in mind. Choose a behaviour that is specific and will help you achieve what you want. To get specific, ask yourself 3 questions. Number 1, what is it that I want? Number 2, what's one thing I can do to achieve this? And number 3, what's the easiest thing I can do to start achieving that one thing? Something so easy you could start it now. I call this the want one now strategy. I want one now, to deciding what behaviour to work on and how to get it started. Want one now. What do you want to do? What's one thing you could do to achieve this? And what is the easiest thing you can do to start achieving that one thing, something so easy you could start it now? Want one now. I want one now. For example, let's say I ask myself the first question, what is it that I want? And I decide that I want to save more money. Then I ask myself the second question, what is one thing that I can do to save more money? And I decide that I could save more money by bringing my own lunch to work. And then I ask myself the third question, what is the easiest thing I can do to start achieving that one thing? Something so easy, I could start it now. I decide that the easiest thing I can do to start achieving this is to bring in something really easy for lunch, like crisp bread or bread and avocado. The crisp bread or bread I can leave in the fridge or freezer at work. And I just need to bring in a topping like avocado or banana or something really easy, grab and go style. Later, once I start building the habit, I can bring more elaborate lunches. But to ease into it, I need an easy option. Something so easy you can start it now. Want one now. What do you want? What's one thing you could do to achieve it? And then what's the easiest thing you could do to start achieving it? Something so easy that you could start it now. I want one now. In the next chapter, we break down my top 5 money habits for managing your home loan. These start off easy, with each habit building on the previous habit. Chapter 36. The single most important money habit. Money habit number 1. Firstly, let's start with the single most important money habit for everyone. It's known as the pay yourself first rule, but I like to call it, you can't touch this money. On my 40th birthday, my family gave me 40 token gifts of things that represent me. One of them was a money box. I've always been known in my family as being a good saver. Yes, I was always very good at saving money. My problem, however, was that I was also very good at spending it. I would save all my money and I would have a large sum, like $5,000, which at 25 years old was a lot of money for someone on a casual wage, and it was a lot of money for me. And then I would blow the whole lot and have to start from scratch to save again, which felt like it would take forever. First, it was a holiday. Second, it was another holiday. And third, it was our wedding. After that third time, I knew I needed to do something different because with the way I was going, I would never have any long-term savings. My husband, on the other hand, was good at saving money and good at not spending it all. He taught me a very valuable lesson. Like me, he started with nothing, but what he did differently was that whenever he earned money, he would put a little bit of that money aside that he wasn't able to touch at all, no matter what. That's right. This was the you can't touch this money. Wherever you are in your home loan journey, you have to put money aside, no matter what. Money that you can't touch. Money you can't touch for a car, a holiday, a wedding, or anything other than a deposit, repayments, or for investment purposes. This is money you want to grow. You can eventually use it to put towards your home loan when you get one, or some other form of investment. You can't touch that money. Period. We purchased our first property when we were about 30 years old. After we got married, we saved every little penny we had. This turned into our you can't touch this savings. And this helped us to save a healthy deposit for a house. If you are buying before you are 25 years old, you may not have had time to build a strong deposit. But if you have some kind of deposit, nonetheless, you can still get into the market and be well ahead of where we started off in our 30s. The sooner you start, the easier it will be later. And even if you start later, it's never too late. You can still do it. How do you decide how much to put aside? Well, that's up to you. How much do you currently earn? Are you saving for something like a car, a holiday, a wedding, or a house deposit? If you are done with large initial lifestyle expenses and you're on to saving for your house deposit, then go ahead and start putting aside your repayment amount that you have worked out earlier. Put this aside as if you already have a home loan. If you are saving for a holiday or a wedding or something else you plan to spend it on, then put money aside for your savings and then also put at least some money aside, such as 10%, into your You Can't Touch This money. Give them 2 separate accounts. Number 1, your savings account for that holiday or wedding or whatever it is that you want. And number 2, that's your You Can't Touch This money account. Of course, you can put as much into your You Can't Touch This money account, but 10% as a bare minimum is a start. Yes, you may have less for your holiday or wedding or whatever, but so be it. At least you will be building your home loan deposit, and you will thank yourself for this later. Otherwise, after your holiday or wedding, you will have to start from scratch again. This is the first main money habit and an important one to building wealth. You will thank yourself later. How to save your You Can't Touch This money. The easiest way to save this money is to schedule an amount to automatically come out of one of your accounts into your You Can't Touch This money account. Choose an amount, schedule it. Then you won't have to think about when to move the money across or how much to put in. It will just happen automatically. Schedule in some time to review this, such as every month, so you can increase or decrease the amount if circumstances change. Put a reminder in your phone to check in on your automated savings. Schedule it to happen when you get paid. For example, we used to get paid on a Wednesday, so I would schedule it first thing Thursday morning to make sure the money was available. If you can't schedule this because you get paid different amounts each time you get paid, work out how you can make it easy for yourself to do this as soon as you get paid. Can you schedule some of the savings and put a reminder in your phone to top it up? Treat it like a bill. You have to pay your bills, so how do you remind yourself to pay those? Give yourself the same reminder for your savings. How can you make it easy to transfer your money to your You Can't Touch This money account? Let's keep building those habits. In the next chapter, we work on building your next habits. Habits 2, 3, 4, and 5. Chapter 37. Build your regular accounting habit. Money habits 2, 3, 4, and 5. Did your eyes roll reading or hearing the title of this chapter? One important but often overlooked money habit is to build up a regular accounting habit. Sounds exciting, right? I know, about as exciting as putting in your tax return. Yes, I get it. Nobody wants to do it, but it is a good idea. The thing is, you probably already have some kind of accounting habit and don't realise it. If you pay bills, you already must do some accounting, or you're about to when you get your first home loan. Maybe we should call it something else, like building your wealth-making habits. Does that make it sound more exciting? Maybe not more exciting. It does make it sound more important though. It doesn't have to take long to do your accounting. You just need to set aside time each week, fortnight, or month. If you're going to do this every week, give yourself 5 to 10 minutes. If you're going to do this every fortnight, give yourself 15 to 30 minutes. And if you do this every month, give yourself about an hour. It really doesn't have to take long. You can even start with 2 minutes. The idea here is to create a habit stack. Build one accounting habit at a time until you have a stack of habits that work to form your accounting habit. You don't have to do all these immediately. Try habit 2 alone, or habits 2 and 3 together, before adding in habit 4. When you are comfortable, add in habit 4 and then 5, or any other accounting habits you'd like to build. Here are the stacked accounting habits that are useful for when you have a home loan. Money habit number 2. Open your online banking account. Money habit number 3. Look at your income and expenses. Money habit number 4. Track your home loan. And money habit number 5, forecast your bills. Let's look at each habit in more detail. Money habit number 2, open your online bank account. Firstly, the easiest place to start is to turn on your computer and open your bank account online. That's right. The place to start is to go online and open up your bank account. That's it. That's habit number 2. You'll notice that it's very easy. So easy it might even seem a bit ridiculous. Let's keep building on that habit. Money habit number 3. Look at your income and expenses. Once you've opened your online bank account, look at your income and expenses. Eyeball them to see what you've earned and spent each week, fortnight or month. Keeping an eye on how much is coming in and going out can be a really useful habit. How much are you spending and earning every week, fortnight and month? Are you spending more than you earn some weeks or months? When we had our first home loan, I did this every week. Now I do this about once a month. And then I'll follow it up every quarter and every year. Are you spending more than you earn some weeks or months? You can break this down into weekly, quarterly and yearly check-ins. Weekly habits. Every week, eyeball your expenses for the week and how much you've earned. I do this because I schedule some bills well in advance and I forget which bills I've scheduled. If I need to transfer more money into our bills account, I do this so we have enough money to cover what we need when we need it. This also gives me a quick way to see if we are spending more than we normally do and why. If I start to see a pattern for eating out that is increasing, I might rein this in over the following week to keep track of this. Quarterly routine. Every 3 months, it's a good idea to add up every bit of money spent and earned. I do this by downloading an Excel file straight from my bank account. It's really easy to do because you can go to your online bank and export the Excel file straight from your bank. You don't have to write every individual item down. It spits it out automatically for you. If you're not sure how to do this, contact your bank to find out how you can download all of your expenses and income from your bank account. It's your money. Once you have your download, you can add in categories for what you've been spending your money on. Now, this does sound like a lot of work. I've set mine up in a way that makes it automated, and I only have to manually try to work out a few transactions here or there. I have an upcoming video that can show you how you can automate that for yourself. Group your expenses into categories. Choose these categories based on your needs. Some categories might include groceries, transport, utility fees, insurance, activities, entertainment, and retail shopping. And add your own categories. Yearly check-in. Now that you have your Excel file from each quarter, once you have a whole year's worth of income and expenses in your Excel file, look at where you have been spending your money during the year. For example, what was spent on travelling to and from work? How much did you spend on groceries throughout the year? Which months did you spend the most or least amounts of money? Having all this information also makes it really easy to do the taxes. Going to the level of tracking every bit of income and expense can be time-consuming, but at a very basic level, if you can get into the habit of just looking at where you earn and spend each week, is really handy. Even just eyeballing it is useful. You could do this every day while you are getting into the habit of it. Even checking in on a weekly basis gives you a really quick way to ask yourself, did we eat out more than usual this week? Did we spend more on petrol or groceries? Do we have more bills this week? Have we had any unexpected bills this week, or has our income changed? Looking at your expenses and income is a really useful habit to build because it will help you see where your money's flowing, how it's flowing in and how it's flowing out. And it will show you where you're spending. You might see that you're spending more than you need to on some things. That's when you can see where your spending is going, and you can decide for yourself where you want to be putting that money, and possibly how you can save more, or whether you need to earn more. Money habit number 4, track your home loan. It can be very easy to lose track of your progress and to lose sight of your ultimate goal of paying your home loan off faster if you are not managing it. The only way you can do this is to be mindful of your repayments, your financial situation, your expenses, and to stay in control of those initial goals that you created. If you would like to pay your home loan off faster, it helps to track your progress. It doesn't take long. We found this to be so important. When we had our first home loan, I did this every 2 weeks. Now I do this about every month. One way to keep track of your home loan is to create a thermometer chart for yourself. Now you might be wondering, what is a thermometer chart? You know those charts, the ones charities use to show how much money has been raised? The more that is raised, the higher the temperature on the thermometer goes until it reaches the top. If you're not sure, Google thermometer chart. Create and put it up somewhere visible or keep it on your computer. Whenever you make a repayment, colour more of the chart in. You can use this to track when you reach major milestones in repaying your principal. That way you can celebrate when you reach certain milestones. Like if you've paid $10,000 off your home loan, or if you've paid $50,000, or if you've paid $100,000. You could even use one that tracks the months instead of the years. I used to count down the months and years as well as the home loan amount. What if I don't want to use a thermometer chart? Of course, you don't have to use a thermometer chart to know how you're tracking. The easiest way to track your home loan is to make each of your repayments in line with how you had planned. If you plan to pay $1,200 per week, and this will pay your home loan off in the amount of time you want it to, then pay this amount each week and keep it up. If interest rates don't change, then just stick to that amount. If interest rates rise, you'll need to increase that amount. If interest rates decrease, stick to your repayment amount. If you earn more money or you're saving more money, maybe consider increasing your repayments as well. Likewise, if you put extra money in, keep a tally of that amount so you can see when you are ahead. We also have a super quick tracker that shows you where you're at without you needing to add it every week, fortnight, or month. You just do this on the fly when you want to track your progress. It's free on paidin5.com/gifts. Look for the super quick home loan tracker. If you notice that after 3 or 6 months that you are dipping back into your home loan account for bills, then it may be useful to review your home loan and possibly change the length you plan to pay your home loan off in. More on this soon. Note that if interest rates rise, then you need to also make higher repayments to stay on track with your repayments. If interest rates fall, keep up the same repayments and you will slowly get ahead of your initial schedule. If you stick to your repayments and interest rates don't rise, you will be on track to paying your home loan off in the amount of time you want to pay it off in. Stick to those repayments and you'll be on track. If you do dip back into your home loan account, make sure you put that money back in and keep a record of how much you take out. Money habit number 5. Forecast your bills. Do you sometimes get surprised when a bill arrives? What? Another electricity bill? Didn't we just pay that? Do you ever miss a bill? Here comes another late fee. Do you ever pay your bills twice? Oops, how did that happen? When we started on our home loan journey, there were new bills coming in. Preschool, home and contents insurance, water rates, strata, and it was hard to keep track of what we had to pay next, or to know if we had enough money for our next bills, or when the next bill was coming. It was hard to plan with all these bills arriving. I already knew these bills would be regular, and I knew each of them would have their own times they would arrive. For example, our water and electricity bills would be every 3 months, whereas our home and contents insurance would be every year. That's when I decided to start planning ahead for these bills. And oh my gosh, it was one of the best decisions to keep on top of all those bills coming in. It takes about 15 minutes to set up, but once it is set up, it's a simple check after that, usually up to 5 minutes each time if you do this every week or fortnight. And gee, it's worth it. There are different bill predictors out there. I find that if I haven't set them up myself, I find them to be a bit of a nuisance because they don't know when I've actually paid the bill, and they remind me of a bill I've already paid. This has caught me off guard in paying a bill twice. So I developed my own bill forecaster. You can use this for free as well at paidin5.com/gifts, which I use to track our bills to estimate any upcoming bills, and I can see all my bills month to month. I have shared what I use, but this is not automated and it won't give you reminders. You'll have to go in and check regularly. So if you find an easier version, by all means use that version. Whatever method you use, stick with one that works for you and use that. This has saved me many headaches in surprise bills and late fees. That's why it got a spot as one of the most important money habits. When you can forecast your bills, you know what you can pay for your home loan repayments. The next chapter, coming right up, talks about which other money habits are helpful to work on. Chapter 38. Which other money habits are helpful to work on? You have now got 5 important money habits to work on for building great habits in relation to paying your home loan off faster. Money habit number 1, the single most important money habit, you can't touch this money. Money habit number 2, open your online banking account. Money habit number 3, look at your income and expenses. Money habit number 4, track your home loan. And money habit number 5, forecast your bills. There are so many money habits out there. What happens when these become habits and you would like to work on a new money habit? Or what happens if you have other habits you would like to work on instead? How do I work out which habit to work on next? One great clue for which money habit you could work on is recognizing when you have a regretful purchase. Yes, we've all had them. Bought something at the store that we regretted buying later. Things like eating out. How did I just spend $100? Or purchasing a whole heap of little items in the space of 2 hours, like lunch, plus a juice, plus an ice cream, plus a coffee, plus a notepad and a pen, of course. It all adds up. Or even overspending when you are having fun, like going to the movies and buying a drink with a plastic gimmick movie cup you had to have, popcorn and a choc top, or maybe more. When you have a regretful purchase, notice how you feel. Write it down somewhere and commit to changing that behaviour. When was the last time you had a regretful purchase? What was it, and has it happened before? What are some money rules or habits or commitments that you can make that you could work on to prevent these regretful buys? Brainstorm some ideas here for what money habits you could work on. You might even like to work on other money habits that you have or would like to create. If you're not sure what your money habits are, here is a simple exercise that will help you figure them out. Over the next 2 weeks, write down all of your purchases that you have made. If you've gone grocery shopping, there is no need to list all of your items. Just write down those things you purchased that you did not intend to purchase, or group them as unintended groceries, and give a total amount spent. Then write down the date and time of day you purchased the item, how much it cost, where you purchased it, what you purchased that you weren't planning to buy. When we go to the grocery store, we almost always come away with more than we planned to buy. For example, did those items sneak into the basket at the grocery shop, or were you always planning to buy them? Were any of these regretful purchases? Then look at this list. We have a tool that you can also use called the Regretful Buyers Tool, free on paidin5.com/gifts. Then look at your list. Can you see a pattern for how you have been spending money in the last 2 weeks? For example, do you shop for clothes that you did not intend to purchase? Did you go grocery shopping many times during the week? How many times did you eat out or order takeaway during the last fortnight? Which days were these? Pick one of those items. So now that you know what you want to change, you can go about changing those behaviours. Try the 1-to-1 now strategy. What do you want to do? What's one thing you could do to achieve this? And what is the easiest thing you can do to start achieving that one thing, something so easy you could start it now? What do you want to change? Coming right up, we have 9 top tips for saving you money while you have a home loan. Chapter 39. 9 top tips for saving you money while you have a home loan. There are also other ways you can make the most of your home loan when you have one. To be able to save money when you have a home loan, quite simply, you need to be able to pay it off faster. The faster you pay it off, the less interest you pay, and the more money you save. Here are my 9 tips for paying your home loan off faster so you can reach your goals sooner. Tip number 1. Be willing to change. Circumstances can change throughout the life of your home loan. Interest rates can change. Job circumstances can change. Life happens. And these can both work for or against you. For example, when we bought our second property, we had a specific amount of money that we wanted to repay. However, we had bills lining up and we were pushing ourselves to meet those repayments. Instead of giving up on our goal of paying our property off faster, we decided that our monthly repayment amount was too high and too overwhelming to manage. We had a moment of, I will be able to repay this amount some weeks, but I won't be able to keep this up regularly or for very long. So rather than giving up completely, I reduced the amount we were repaying to an amount I knew we could meet each month more comfortably. It meant having to go back and change our timeline for when we wanted to pay it off, but we were okay with that, as it only meant adding 2 years to our home loan, which was still well and truly under 30 years, and still helped us to save hundreds of thousands of dollars on our home loan. Circumstances might change. When these changes occur, you also need to change what you are doing to stay in control of your financial goals. If interest rates fall, great. Don't lower your repayments, keep them high, and you will pay your home loan off sooner. If interest rates rise, recalculate how much you will need to repay to stay on track with your goals. If you can't increase your repayments, then you will need to increase the length of your home loan. Instead of 5 or 10 years, you may need to aim for 7 or 12 years. If your income is lower, for example, you lose one wage, as we did for a short amount of time when our second child arrived, you may need to adjust the length of time you intend to pay your home loan off. If your wage increases, great. Increase your repayments so you'll end up ahead of schedule. If you must do something differently to continue with your original plan, then do that and don't give up. If you have to add another year or 2 to your 5 or 10 year plan, that's okay. 6, 7 or 12 years is still a great place to aim for and can still save you hundreds of thousands of dollars. If at this stage you now have a home loan, it's a great idea to keep track of your home loan every week, fortnight or month. Schedule in time every 3 months on top of this to reevaluate your home loan to see if you need to make any changes to your goals, Whatever life throws at you, always check in on your home loan repayments and adjust your goals or your repayments to suit your situation. Maybe you need to increase the length of your home loan. Maybe you need to make higher repayments. Only you know your situation, and you need to work towards changing when life changes. Managing your home loan will help you manage your goals and help you stay on track to succeed in your goal of paying your home loan off in your set time. Tip number 2. Always know what your interest rate is. During the life of your loan, you should always know how much your interest is. If you don't, why not? This will help you to stay in control. If interest rates rise, you will need to increase your repayments to pay your home loan off in the time planned. And if interest rates decrease, you can pay your home loan off even faster if you keep your repayments the same. Tip number 3. Open other accounts, including an offset account, but only if it is beneficial. Many lenders, particularly banks, will offer you other accounts that you can open at the same time you take out your home loan. This can be useful. For example, if you have an everyday account with your lender, you can easily transfer money to your home loan account as you please. And it happens immediately. If you're moving your repayments from a different bank account into your home loan account, the money may not appear for 2 to 5 business days. This could lead you to falling behind on your repayments even when you pay on time. So having your accounts sit together where you can move money immediately can help. On the plus side, if this account happens to be an offset account, this works even more in your favour. Any money sitting in your offset account works to pay off the interest as if it was sitting in your home loan account. Plus, if you want your home to become an investment property in the future, you can take out that money as you please. Now you might be wondering, well, why can't it just sit in my home loan account? The thing is, in Australia, and I don't know what it's like in other countries, but in Australia, if you've made repayments into your home loan account and you've basically paid your home loan off, by the time you want to move out, you can't actually take that money out because it's in your home loan account. But if you put your extra repayments into your offset account, then you can take out the money from the offset account. It's just a rule in Australia where you can't take your money if it's in your home loan account, but you can take it if it's in the offset account. So when you're making repayments on your home loan and you're paying more than the bank expects you to pay, put that money into an offset account. Keep it there, and you'll always be able to use it later if you need to or want to. For example, imagine you're paying your home loan off in 5 years. Put your minimum repayments that the bank expects you to pay into your home loan account. All of the rest of the additional repayments you'll be making go instead into your offset account, not into your home loan account. Make sure they go into your offset account. That way you can use your money later. If you decide to rent out your property, that money you have sitting in the offset account will be available to buy another property or to do something else with. It won't be stuck in your home loan account. You just can't take that money out of your home loan account, but you can if your money sits in an offset account. What? These are the tax rules in Australia. If you are buying property in another country, you will need to check your country's tax laws in whichever country you live or buy property in. You still need to make your repayments to your home loan account. This is really important. Keep making your repayments, but only the minimum amount. And then pay the rest into your offset account to help you keep saving more money overall. Having an offset account could work out to save you thousands of dollars over the full length of your loan and help you to buy your next property sooner. It is well worth considering, but it does come with fees, so weigh up all your options. Maybe the extra fees are not worth it. Tip number 4. Whenever you have the money, make repayments. In general, paying weekly will save you the most money. The interest to be paid on your home loan is calculated daily, so if you pay weekly, your interest rate will be charged on how much money you have left to pay off every week. If you pay fortnightly, the amount you pay interest on is higher for that extra week you are not repaying it. By making weekly repayments instead of fortnightly or monthly, you will be able to pay your home loan off faster. However, this does come with a warning. If you don't get paid weekly, do not split your home loan repayments up into weekly portions just so that you can pay weekly. Pay your mortgage off when you get paid. For example, if you get paid fortnightly, pay your home loan off fortnightly. If you get paid monthly, pay your home loan off monthly. Don't have money sitting in your everyday account. Don't wait to pay it off another week. Pay it off straight away when you have the money. Otherwise, you will be charged at a higher rate on your home loan for an additional week when you could have already lowered it the week before. Whenever you get paid, make repayments. Tip number 5. Make extra repayments regularly. By now, you would have worked out your ideal maximum home loan and the repayments that go with it. Stick with this. Always pay more off your home loan than the minimum expected of you by your lender. If you choose to make only the minimum home loan repayments expected by your lender, you will be paying your home loan off over the maximum term, such as 30 years. At the end of your home loan, you may end up paying more than double than what you had paid for the property in the first place. When you plan to pay it off faster, do so. Keep up your repayments in line with what you planned based on the length of time you want to pay it off in, and you will pay it off in that set time. Tip number 6. Whenever you can add to your home loan repayments, do so. You may come across extra money when you receive a work bonus. We've never received a work bonus. You never know, some people do. Or a tax return. Get your tax return in early to benefit the most from this. Or a rebate. Or an overtime payment. It doesn't matter, but by choosing to put this extra money towards your home loan through lump sum repayments, you will be able to pay your home loan off faster and you will pay less interest overall. Tip number 7. Make sacrifices. If you want to pay your home loan off sooner, a little sacrifice, particularly in the early years, will go a long way. Look at your expenses. What are you spending money on that is not necessary? Do you buy your lunch? Do you often go out for dinner? Do you have pay TV? Do you buy coffee regularly? Do you buy lottery tickets or scratchies that you could forego? Can you reduce your phone bill? Do you buy something unexpected every time you visit the shops? These are some of life's little luxuries that are only small expenses, but they can add up to a lot by the end of the year. Small spending every now and again won't break the budget, but small regular spending can. It accumulates, and it's that accumulation that makes the difference. If you make small, frequent purchases, consider this. That takeout lunch you buy every day could knock off over a year on your home loan and save you thousands in interest repayments. If you make small, frequent purchases, what you are effectively doing is adding that to your home loan every day. Is it worth it? Can you let go of some of life's little luxuries and make sacrifices in the short term for long-term gain? Tip number 8. Avoid financing toys or other unnecessary items. We now know the interest rate and the time taken to pay off a home loan will determine how much it costs you to borrow money. The less time you take in paying off your home loan, the more money you can save. However, if we were to increase the amount of money borrowed to finance a toy, whether it be through a current loan or a new loan, the increased amount of debt you have committed to will cost far more money than the amount you borrowed. It will prevent you from getting ahead on your current loan. Let's take a look at an example. Say I love fishing and I decided to buy a boat for $50,000. I take out a loan from a boat company with an interest rate of 15%. Interest rates on personal items tend to be higher than interest rates on home loans. And then I commit to paying $250 a week towards my boat. After 6 years, I would have paid my boat off and with it paid over $24,000 in interest. The true cost of this boat at this stage is $74,000 plus fees. However, before I can start to use my boat to go fishing, I need to buy a trailer, pay for registration and insurance for both my boat and my trailer, and fit a tow bar to my car. This cost me a further $10,000. My $50,000 boat now costs me $84,000. Now I can make good use of my boat and go fishing as I please. To do so, I will need to pay for general ongoing costs, such as fuel, servicing, and repairs. This takes further money away from my budget and costs me an additional $5,000 per year. Note, I have been conservative here. Therefore, the amount of money I have now used to buy and run my boat, or how much my boat has cost me, is more than $89,000. Then there's insurance and all the additional things you must buy for your boat, like life jackets, flares, oars, safety equipment. That could add an extra $2,000 plus. This $50,000 boat is now over $91,000. The opportunity cost of the $91,000 used to buy and run my boat is money that could have been used to make extra repayments on my home loan. If I used the $91,000 towards my home loan, I would have reduced my principal and paid more off my interest. About $5,000 in interest could have been saved in 1 year depending on the home loan. Therefore, the $91,000 used to buy and run my boat has cost me a further $5,000 in interest repayments on my home loan that I now need to make on my home loan. A better reflection of the cost to buy my boat rather than making extra repayments to my home loan has cost me over $96,000. Now I know that I have generalised the 6-year boat loan into 1 year, but you can see where I'm getting at. In summary, to finance a toy, you may need to end up paying for the initial cost of the toy, plus interest on the toy, plus fees, plus additional costs to enable you to enjoy the toy, for example, tow bar, trailer, life jacket, plus ongoing costs such as insurance, maintenance, servicing, registration, repairs, running costs like fuel, plus the additional interest you end up paying on your home loan because you have taken the money from there and put it into your toy. It all adds up. If you buy a boat outright, and if your life revolves around boating, then this is a different story. Instead, you may opt to pay your home loan off for a longer period of time. You may want to pay it off over 12 or 15 years instead of 5 to 10. And you would still be winning in comparison to a 30-year loan. Just be conscious of what you are spending your money on and how it impacts your home loan. If you cannot buy a boat outright, then consider paying your home loan off first and do it fast so you can buy an even nicer boat later. For a shorter pain, holding off on the boat, you can pay your home loan off faster and still have your boat when you're done with your home loan. I highly recommend avoid financing toys. Don't take out a loan for a toy, and this will allow you to concentrate on paying your home loan off faster. If you can't buy it outright, then wait until you can. The quicker you pay off your home loan, the faster you'll be able to spend that money later, and you'll be able to buy your dream boat outright sooner. The same principle also applies to taking out personal loans for cars, holidays, a wedding, or taking out any other personal loan if you can help it. The interest on personal loans is high, usually more than 15% and sometimes even over 25%. Some people justify taking out personal loans so they can get a good credit rating. I can tell you, we have never taken out a personal loan. When we bought our first and second property, we also didn't have a credit card. We only ended up getting one because we had to when we wanted to hire a car. It was mandatory. We had to have a credit card, and we only ever used it for that purpose. But we've never had a personal loan, and we don't really have a credit card, and our credit rating is in excellent health without these unnecessary loans. Personal loans will drain away any money that could be going towards your home loan or for a deposit on your first home. Avoid personal loans if you can. Tip number 9. Avoid dipping into your home loan account. Try not to dip back into your home loan account if you can absolutely help it. Once you start falling behind on your repayments, it becomes very difficult to catch up again. Not dipping into your home loan will help you to stay on track to paying your home loan off in the amount of time you had planned. Many accounts these days have redraw options on the home loan account, which is great, but this can easily get out of hand. When you take out a home loan, your lender may advise you that you can put all of your income into your home loan or offset account and redraw money when you need it. This is a piece of advice that we did not take from our lender. This may seem like a good idea, as it can save you time and hassle of having to keep on top of when your income comes in and then moving it to your home loan account. But it becomes very hard to keep track of your expenses if you do this, and you will probably end up taking out more than you intend to. In particular, when there are multiple bills coming in, such as car registration and insurance, school or daycare fees, sports or extracurricular activity fees, utility bills, etc. Your redraw habits can get out of hand. You may lose sight of your redraw habits and your initial goals of paying your home loan off faster. If you want to pay your home loan off faster, it is so important to be mindful of what you redraw. If you really want to put all of your salary into your home loan or offset account, decide how much you need to cover expenses until the next pay date and redraw that amount only. Then avoid redrawing again in that period. And make sure you don't take out more than what you had planned to repay, otherwise you may not reach the goals you intended. It can be very easy to get into the habit of taking extra cash out regularly, losing track of your redraw, and failing to manage your home loan repayments in line with your original plan. So be careful of this. How to avoid dipping into your home loan account. To avoid frequently dipping into your home loan account, I recommend you A. Be mindful of your redraw habits and pay back anything you take out when you can. And B. Set limits on your redraw. If you already have a home loan and have been using redraw regularly, calculate how much you have been taking out and the times you have redrawn most frequently. It may be a particular month in the year when bills are high. This will help you determine your spending habits. Set a budget and calculate whether you are taking out over and above what you had planned or intended to. If you have to, re-evaluate your repayment amount and the timeline for which you want to pay your home loan off so you can redraw less frequently. Our income went into a separate account to our home loan. When we got paid, we would keep enough money aside to cover expenses until the next payday, and then we would put the rest into our home loan and offset accounts, which worked out to be, on average, $1,200 per week. On our second home loan, our circumstances were different. I came back to this book and created a new plan once we had our home loan. Initially, we were working hard to pay this off. We soon realised that we were pushing ourselves too hard. Because we had already gone through 5 years of tight budgets, we wanted to allow ourselves to have more spending money for the kids to take part in extracurricular activities and for holidays. Our plan was more relaxed than our first purchase, and that's completely okay. On our "How comfortable are you in making your repayments?" we aimed for "I can repay this amount comfortably," instead of "I will be pushing myself to repay this amount, but I'll be able to manage." This meant we would take longer to pay our home loan off and pay more interest than if we really pushed ourselves. I then started putting our intended repayment amounts into our offset account, minus the minimum. We then had a set repayment amount that we paid every month. When interest rates rose, we increased this, but everything else we kept as spending money. Money we could spend on bills, holidays, kids' activities, and general spending. We then very rarely, if ever, took money out of our offset account. And if we did, we always found a way to put it back quickly. If we had a lot of bills one month, there would be another month the bills would be slightly less, and we could put the money back. At the end of the year, we could use leftover money for a holiday. And since we were now house swapping, this meant we didn't have to spend money on accommodation, and instead had more for keeping ourselves entertained on holidays. Remember, the more you pay off your home loan, the faster you will pay it off and the less money you pay on interest. The less you dip back into your home loan, the faster you will repay your home loan and the faster you reap the rewards. Next up is the final chapter where we wrap up Pay It in 5. Chapter 40. 5 Steps to Paying Your Home Loan Off in 5 to 10 Years. So there you have it. You now have all the information you need to be able to pay your home loan off faster and the tools to go with it. You're welcome. And all it takes is 5 steps. Number 1, plan. Number 2, calculate. Number 3, borrow. Number 4, buy. Number 5, manage. Each step offers you practical advice that you can take and use straight away. Before we purchased our first property, I worked out how much we could repay regularly, and from that, how long we wanted to pay our home loan off for. With knowing how much we could repay and how long we wanted to pay it off for, we set about working out how much we could borrow for us to be able to pay our home loan off in 5 years. And if interest rates did not rise, we then went on to only purchase a property where it was actually possible for us to pay it off in 5 years. That's how we did it. That's the secret. Purchase within your means to pay off in the time you want to pay it off in. Know how much you can repay, when you want to pay it off in, and then work out how much to borrow. This is how you reverse your home loan thinking. Instead of starting with how much you can borrow and then working out how much you have to repay, you flip it. You work out first how much you can repay, when you want to pay it off in, and this helps you work out how much to borrow. By now, you will have created your own goals for what you want to buy, how much you want to borrow, and how much interest you want to pay on your home loan. We started this journey when we were 30. If you start before you are 30, you are already ahead of us. The earlier you start, the easier you make it for yourself when you're older. However, it's never too late to get into the market, so long as you have an income and you can keep up with your repayments. Now that you have the knowledge and the tools, schedule in a time to come back to this book every 6 months or every year to remind yourself of the underlying principles of paying your home loan off faster, to re-motivate yourself when keeping a tight budget gets to be hard work, and when you are looking to buy your next property. Even I still use this book as a resource to remind myself of what to pay attention to in our home loan. And yet, I wrote the book. Everything in here I wrote and experienced. and I have continually updated this book as we have travelled along our home loan journey. Now it's over to you. What have you found to be the most helpful in this book and how? I would love to hear about the ways this book has helped you. #PayItIn5 on social media to share your journey with me, or drop me an email via payitin5.com. And don't forget, we have so many tools available for you for free. Just head to payitin5.com/gifts and enter password 1234. These are the tools that I use at home. I designed them to help us, and I believe everyone should have access to these if they want to get ahead faster on their home loans. You don't have to recreate them yourself. That's why I made them free with this book. And before I finish up, here is a quick recap of those 5 steps. Happy house hunting and best wishes on your home loan journey. Step 1. Plan. Look at why you are buying. Plan how long you want to pay it off for. Think about home loans in reverse. Step number 2. Calculate. How much can you repay regularly? Work out your principal to interest split. Calculate your maximum home loan and buying budget. Step 3. Borrow. Aim to understand. Shop around and do your research. Ask lots of questions. Use our 30+ questions. Step number 4. Buy. Review your aims and prioritise. What are you looking for? Be ready to buy. Move mountains to meet your settlement date. Step 5. Manage. Track your progress and celebrate. Build healthy money habits and adapt. When you have the money, make repayments. And that wraps up Pay It in 5. To give you a little bit of a background about who I am the founder and author of Pay It in 5. I created the 5-step method to paying a home loan off faster, and I'm sharing these steps so you can do it too. Together with my husband, we paid our home loan off in 5 years with 2 young children, 1 average full-time wage, and 1 off and on casual wage. I created this practical guide after I got a PhD for my work in psychology. I have a statistics and research background, which helped me to create the steps and tools for Pay It in 5. You don't have to be good at math to pay your home loan off faster. This is my first self-published book, written for everyday use. I hope this helps you. It definitely helps us and continues helping us in our home loan journey. If you'd like help to plan your home loan and how you can make it work for you, head to payitin5.com/coaching to book a time to chat with me or the team. In life, you get what you spend your time doing. You've just spent your time learning how to pay your home loan off faster. Head to payitin5.com to book your session and make money work for you.